Okay, thanks, Raz. We have the sound on. I've been rambling to myself for the first minute. Okay, what I was saying is, for today's live stream, we do have a... Can you guys hear me now? Jaden, can you hear me? I think my microphone was off. I just turned it on, but I think it should work now. There we go. There we go. Hi, Philippe, Jaden, Raz. Okay, what I was saying there while it was muted, hey, Sam, is I really appreciate when you guys come with questions, because I don't really know what's valuable to share to you guys with regards to how we allocate capital. But when you ask me a question, for argument's sake, how are we going to allocate the 10% that's in the portfolio? It's a great opportunity for me to break it down in simple terms and try and share sort of the meat and potatoes of how we go about actually allocating capital. So I've got a bit of a itinerary here today. It's going to take a while, but don't worry if you guys have to run, that's fine. You can use the same link in order to watch the replay. So what we're going to do today is, first and foremost, the market's been a little bit wild this year. This is, this has been a really difficult year, certainly for me, because we've had no recession. I know that's a common view that we're currently in a recession, but that's just untrue. And I want to share what actually happened this year. I want to break down like where the data is right now. The economic data is still quite strong. We may go into a recession. I'll talk about that. And I'll talk about why the market actually was down this year, which makes it very difficult to allocate capital. This year was kind of rare versus prior market, relative to prior markets. And so I want to share the difference between 2022 versus 2019 versus 2015, 2016, and why I still believe owning equities over reasonable time horizons the best opportunity. Then portfolio construction. So we always have to consider our expected return versus just maybe going passively owning the index. There's a little bit... Index investing is essentially a macro bet. It's not really a case of dollar cost average in, I'm going to make money in perpetuity. Just because it happened in the past doesn't mean it's going to happen in the future. And I want to go over that because essentially the bet you're making is GDP growth plus inflation and operating efficiencies. So it's not a case of it purely being passive. And I want to explain, the difference between active and passive, because we always have to consider that passive route as well. Can we beat the market long term? Yes or no? If the answer is yes, well, then we should be active. If we don't believe that we can, well, then we should be just investing in a broad index, essentially. So I want to go over my views on active versus passive. The drivers of share price is really two that I've seen in the past, 13, 14 years, two main drivers of assets. One is discount intrinsic value. So we can look at a business and understand that it's undervalued relative to its future cash flows, which we'll talk about, and return on invested capital as a measure of profitability and forward guidance. We'll go over both of those, and I've got a bunch of examples that I'm going to show you guys. I've even broken down every single company in the S&P 500 that there's 119 that have strong, long-term, consistent, high return on invested capital. And I think you guys will be surprised that it hits that hurdle rate of 19.5%, not adjusting for its dividend in terms of total return. So you guys will be surprised that quality businesses that are very profitable tend to outperform with strong forward guidance. And if you can buy them at a discount to its intrinsic value, you can make big outsized gains. Diversification and the efficient frontier. I'm a big believer in diversification. I know an awful lot of people don't like diversification. I think this year is kind of an eye-opener. Harry Markowitz came up with the modern portfolio theory. It assumes maximum diversification falls between 25 and 35 positions. I want to talk about that. And investing has a high fail rate. Now, a high fail rate to me is anywhere from 20 to 60% in some cases, even more. George Soros had a success rate of 27%. He was wrong 73% of the time, yet still knocked it out of the park, greater than 20% compounded. So there's a high fail rate. Doesn't mean that you can't make money, but you have to factor it in, and diversification is very important. Markowitz says that there's really a limitation to diversification, 25 to 35 positions. Again, we'll talk about that a little bit later. And then some of the recent changes, closed positions added, and potential additions. We've got 10% of the portfolio that needs to be allocated. Just a caveat here to anybody that's going to watch this later on YouTube that's not invested in the portfolio. If you decide to go invest in any of these companies, that's on you. That's not on me. I don't want to hear about it in 6 months. I don't want people asking me for an apology. If you want to go invest in these companies, do your work, figure it out yourself, take responsibility. Okay, let's get straight into it. We're going to start off here with the market. There's been no recession this year, right? So we'll start off here. I've made this easy for myself, so I've put a couple of notes here. Let's start off here with real GDP, where we currently are. What is real GDP? Well, GDP is gross domestic product. It's not a great metric, but it's some sort of idea as to the economy's growth. Real GDP is growth minusing inflation. So we've had high inflation. Very important to recognize real GDP. So this year, real GDP for the first 3 months, or 3 quarters, excuse me, was 1.9%, meaning that we have positive real growth in the US outside of inflation. When we look at where we are for Q4, as of the 9th of December, we're almost finished Q4, it's trending at 3.2%. Very strong year for real GDP. Yet everybody seems to believe we're in a recession. We're not in a recession at all. When the share price of an asset goes down, that's what creates a narrative, whether it's the market, assuming we're in a recession. And the problem is it's what's known as recency bias. We always look to the last crisis and we assume that that's the same today. Everybody's looking to the global financial crisis and trying to come up with some parallels, and it just doesn't exist as of right now. The market went down, and I'll explain that in a moment. I've got a couple of things that I want to show you guys, but the market went down and it has nothing to do with economic conditions and everything to do with sort of the neutral rate. So GDP this year is going to end the year positive. We had no recession this year. Now I have comps versus 2015. Okay, industrial production. Let's have a look at coincident data for 2015, 2016. 2015, 2016, 2019, in both circumstances, economic conditions were way worse, not even close. As you can see, 2015, 2016, both industrial production and durable goods turned negative. We could have been in a recession in 2015, 2016. In 2019, we were in a global manufacturing recession. And in 2022, we're growing. We're growing for durable goods, 10.7%, and I'll talk about that in a moment. And we've grown year over year into October, 3.28% for industrial production. So it couldn't be more different than previous economic cycles. The economy has actually been quite hot this year. Again, let's differentiate economic conditions with equity valuations, because that's more a function of liquidity, which we'll get into in a moment. But as you can see here, the economy has been very strong all the way up into where we currently are. We've got 3.7% unemployment, 6.4% wage growth. PMIs, manufacturing dipped into 49, but that is what's known as a diffusion index. So it's only starting to turn down. It's at its peak. It's at its highest point right now. It's starting to look a little bit weak. That could feed on itself, and we'll talk about that in just a moment. Next thing we're going to talk about is labor. Okay, so labor markets. What's actually driving the economy to be very strong? The phenomenon moving forward is it's really about labor market. What actually drives consumption is wage growth. When people retire, they become a net spender. They draw down their 401k and they spend it into the end of their life. And then it's the pool at the margin, it's the pool of labor that actually drives that the wage growth actually drives consumption, because 70% of the United States is personal consumption expenditure. So if you have a look at labor force participation rate, this essentially means the entire population of the United States, what percentage of that is in the labor market. And what we can see in 2007, this had a big decline of about 4%. Now, 4% of over 300 million people is 12 million people leaving the labor market. Why? Baby boomers and millennials were exactly the same size. Baby boomers are from 1946 after World War II into 1964. I've gone over this a number of times, but the lineup is uncanny and it explains everything that we're seeing today. 2007 is 61 years on from 1946. 61 years later, the average retirement age. Boomers started to retire in 2007, have been retiring ever since. That's why the trend is going down. Labor market's getting tighter. And what that meant was, since after the global financial crisis, wage growth started to pick up and it hasn't slowed down yet. The labor market's gotten tighter and tighter and tighter. And although economic conditions might be slowing down for certain parts of the economy, I say slowing down, and we'll talk about that a little bit later, wages are not coming down. And the reason being is it's very hard to attract labor. Goldman Sachs came out recently and said, never in their history, the CEO Solomon, never in their history have they had such competition for labor. People are just trying to capture their talent. There's a much smaller pool of labor, 12 million to be exact, in the United States. And without a change in immigration, which is unlikely in the United States, we're going to continue to see high wages. Now, higher wages means one thing, higher wages. So is that the next part? So yeah, wages and fixed rate debt. So higher wages, personal savings, we'll get to that in just a moment. So higher wages in tandem with fixed rate debt. Here it is here. Higher wages. You've got a 65% home ownership rate in the United States, 98% fixed rate mortgages. Average fixed rate is 3.3%. So if inflation is running away, those costs are not getting more expensive. It's only at the margin. If you had to go out and buy a house today, okay, then you have to pay 6.5% for a mortgage rate. But 98% of homeowners have fixed rate mortgages paying on average 3.3%. And when you have 6.4% wage growth and you've got fixed costs on your liabilities, your debt service payments are not increasing at a faster pace. So just to give you an idea as why this year the economy is very strong, markets are going down. Again, we'll talk about that in a moment. But why the economy is very strong is because consumption has remained very strong. And it's driven by labor market dynamics and credit market dynamics. 80% of corporate debt is fixed rate. 98% of homeowners in the United States have fixed rate mortgages, averaging 3.3%. And those dynamics mean that there's positive cash flow to homeowners. At the margin, there's going to be another subset that are actually hurting, but the majority are actually doing pretty fine. So the next thing that's going to be very important is, so we'll see it here. As you can see, personal consumption expenditure. There's a lot being said about this chart here. You're seeing it everywhere, but it's a complete misnomer in my view. Personal savings rate, this is the flow of savings. And the flow of savings is down at 2.3%. People assume that we're in a situation where the world is ending and consumers have no more money, and that's really far from the truth. So I've got the four largest banks here. You got Citigroup, Bank of America, Wells Fargo, JP Morgan, and I've got up here total deposits. And as you can see, year in, year out, deposits have grown. Consumer deposits continue to grow. So the stock of savings is not considered in that chart. And the stock of savings is net cash, net savings of 1.6 trillion. So the consumer is going to take years to hack through that. It's going to take years to break that down. And this is the flow of savings. So what is actually happening is consumers fancy their future prospects and they're spending today because they don't have any concerns about future job prospects. And we can see that in consumption. Personal consumption expenditure, which is 70% of the economy, it's about, I think, 17 or 18 trillion dollars, is up 8.4% year on year, very elevated. So if you even wanted to take inflation headline, 7.7%, it's still growing in real terms. Consumers are spending more money. There's real growth there. If you wanted to take core inflation, 6.3%, simple maths, let's take the two of them away. There's still positive growth. The economy this year did not go into a recession, but that may not be the case next year. So as of right now, what we've seen is a very strong economy this year, all year. And we'll talk about why that might be coming to a possible end. But not only would it be coming to an end, but it's likely a shallow recession for the reasons we mentioned a moment ago. Labor force is too thin. The unemployment rate may increase, but it will only increase marginally. And wage growth is expected to remain quite elevated while you have fixed rate costs and a big chunk of positive real savings, $1.6 trillion. So the economy itself is actually quite strong. And I think a lot of people are missing the nuance, the smaller details that actually matter. Fixed rate debt, for argument's sake, wage growth, the participation rate. Why is the participation rate collapsing over the past 15 years? These are questions that I think people are ignoring, but have answered why the economy has been quite strong this year. So then the next question is, why did stocks actually draw down this year? And this is something that a lot of people can't comprehend. Mike Shell has his own fund since 2004, I believe, Shell Capital. Just came across this guy recently, but this chart explains absolutely everything. This is the S&P 500 weighted average cost of capital. It's gone from 4.1% to 6%, right? So it's a big, massive jump. What does that actually mean? Weighted average cost of capital. And why would the markets draw down? Because we went from 4% to 6%. Well, we have to go back to March. And this is where I got it wrong. And I mentioned it back in April and May. This is what I got wrong. We had discounted 1.75% for the Fed funds rate, okay? And then as Russia invaded Ukraine, very quickly, the market started pricing in 3%, 4%. We're currently at 4%. We're at 3.75 to 4% right now. That wasn't priced in earlier this year, and that's the bit that I missed. Higher interest rates mean the weighted average cost of capital spikes significantly, and that's what we've seen this year. So why is that important? Well, I've done a little chart here just to explain something. Let's say I borrowed $100 at 6% interest. The interest expense on that in year one is $6. In year two, it's $6. In year three, it's $6. In year four, it's $6, and that should be year five. In year five, it's $6. Now, if I don't invest that $100 in year one, my $100 goes to 94. In year two, my $100 goes to 88, 82, 87, and 70. What does that tell you? Well, what it tells us is that the present value of cash today is worth way more than it is in 5 years because we have to discount it relative to the cost of capital. This is a really basic way of explaining it using interest rates, but we would look at the cost of capital in terms of interest expense and cost of equity. And we use the capital asset pricing model where we look at a risk-free rate, US 10-year bond, and we look at the equity risk premium, and then we multiply it by beta, and that gives us the cost of equity. And then depending on the amount of debt versus market cap, we consider what the weighted average cost of capital is. So if you can imagine that, as Mike's chart points out here, we were down at 4%, meaning that we would discount the coupon of cash flows into the future at a lower rate, meaning there's going to be more cash flow. If you've increased that weighted average cost of capital, the discount rate by 50% or 2%, like from 4 up to 6, well, then the future cash flows are worth way less. What does that mean? It means that we're moving away from long duration assets and we're pulling everything to near duration. Valuations have to come down significantly. So everything that we've seen this year is just entirely a function of monetary policy, higher interest rates, but not just monetary policy. It was the pace of change that we've seen from monetary policy, literally adding like 3.75% in interest rates in like 7-8 months. It was the pace of the increase that kind of caught me off guard. And that's everything that we've seen this year. And most people will look at the market and say the market's down, therefore we're in a recession. That's not a fair reflection. It's not a fair reflection, and at least as of right now, that's not where we are. So I hope you guys understand that. If you don't, just dump a question in and I'll be happy to get to you guys. So I see that Jordan has one there. My view on inflation is that it's good for stocks and GDP as it brings up valuations. Thoughts? We're going to talk about that later when we talk about active versus passive. That's a really important point. But yeah, we're going to talk about that in a moment. So if you guys have any questions as I go along, please ask. So what happened this year was the cost of capital increases by 50%, and therefore we move closer to short duration. And as we move closer to short duration, valuation has to come down, stock price comes down, but that doesn't mean that the economy is in tatters, despite what people are telling you. And to somebody that's not going to go deep enough into markets, it might seem plausible that we're in a deep recession, but if you want to go a little bit deeper, you begin to realize that a lot of what happened is just higher cost of capital, discounted cash flows. Cash flows in the future are not as they're not worth as much as they were maybe 1 year ago. So that's why the stock market's down. So strong economy, no recession, but the market's down because of the cost of capital increased at such a fast pace. And I can tell you the pace at which the Federal Reserve moved caught me off guard as well. So that's what really made this year different and really difficult to navigate. Was you have a situation like, I use Crocs as the example because this is a company where the market thought that, it got down to 4.4 times earnings, and, it's delivering 53 times growth, 53% growth this year. And they never slowed down. They actually increased guidance throughout the year, yet the market continued to price it down to 4.4 times, 4.6 times earnings. Essentially saying like, is it going to bankrupt or something? Like it was pretty bizarre. But that's what really caught me off guard. So in 2023, the question is there going to be a recession and how do equities react? It's highly plausible, and I'll explain why in a moment. It's highly plausible that we have a shallow recession, but equities actually go up. And I'll explain, and part of it's got to do with the cost of capital coming back down, but also part of it has to do with the backdrop of the economy, which is the consumer and the household not being over levered and having net cash. And I'll explain why we might go into a recession. So let me change the screen in which I'm sharing, and let me show you a different screen. One second. There it is. There it should be a whiteboard. So I'm going to show you this one here. Okay, cool. All right, so we need to understand what drives an economy. Okay, so I have a video on a channel that does a couple of tutorial videos, and this is from that, but it'll help explain why I think we're going to see a potential recession next year. So, and why it will be quite shallow. So we have a central bank, and the central bank doesn't just print money. They mint reserves, and those reserves are sort of like, they have kind of conditions. They can buy certain things. They can buy government bonds, mortgage-backed securities, and they're also used to regulate commercial banks. For every loan that's created, has to be backed by an equal amount of reserves that are minted by the central bank. And so credit gets created in two different ways. So as you can see here, if you want to give out a loan of $100, you need to have the equivalent number of reserves backing it. And over here with the government, you can buy government bonds. So the government issue bonds, you can buy those, the central bank can, and then the government spends it. It's deficit spending. And both of these end up creating credit. There's a caveat though. You can't just create money. You can't just print all these reserves and assume that the market's going to go out and essentially borrow all this money and invest. There's two caveats. The first caveat is banks need to be willing to lend. In other words, they need to make a profit. And the second caveat is customers need to be willing to borrow. So like, if I have nothing to buy, why would I go and borrow from a customer's perspective? If I already own my house, if I own my car, quite content with that, there's no maybe business opportunities, I may not want credit. And as well as that, banks need to make a profit. So maybe the consumer's ready and able to borrow, but as of right now, based on where the markets are currently at, banks may not be willing to lend. So that's where I think we are right now. So let's understand the different yield curves. So this is where we were a year ago. Right? So we've got different yield curves. As you can see in blue, this is 2022 into November when I created this slide. And in red was 1 year ago. So as you can see here, this is the difference between this is the yield curve. So as you can see at the bottom, 1 month all the way into 30 year. And over here, you can see 1 month into 30 year. So how do banks make money? Well, they make money off of the deposits or the rate at which the credit's created out of fresh air, but there still needs to be an arbitrage there. So normally how banks make money is they pay on the short end and they lend out on the long end. And the spread between the two previously was short duration savings, for argument's sake, would be on the short end, and on the long end would be like a mortgage rate. And if this spread was positive, banks would be willing to lend because they'd be profitable. This is really important. And as you can see at the top here, we've got a situation where yields, when I made this, which was only about a month or so ago, we've seen a situation where on the short end, rates were at 4%, and on the long end, rates were at 4%. So banks are less likely to lend, right? And the reason being is because they make no money. So we're at a situation where consumers are healthy, $1.6 trillion in net savings. They're probably going to continue to see positive flow of savings. Cash flows are, you've seen deposits at banks are probably going to continue to flow higher. Why? Positive earnings growth. At the same time, you got fixed rate expenses in terms of debt. And so consumers are still going to be fine. But the second part of that equation is banks are just not going to lend money if they're not going to make anything, right? And that's the catch-22. So where we are as of right now, I've got here the yield curve versus revolving credit rate of change, but it doesn't matter. I just want to show you guys where the yield curve is as of right now. Normally what we could look at is the 10-year minus the 2-year, which is what I have here. But when inflation's high, this can go negative for like 2 years before it ends up playing out. You can see back in the 1970s, it was like 1.5 years and 2 years before we had a recession with very negative yield curve. You want to be looking at like the 10-year minus the 3 month, and the 10-year minus the 3 month is negative as of right now. So banks are not making any money on the short end versus the long end as of right now because curves are inverted. Across the curve, we've got inversions. So I hope that understands the difference between credit expansion. Customers need to be willing to borrow and banks need to be willing to lend. And so if I go back over here, I just want to show you one more slide. If we go back to here, I want to show you guys this slide. Where is it? This slide here. So this is residual assets less liabilities from all commercial banks. This is like when you understand, like if I create a loan, I'm a bank and I give you a loan, that's an asset to me. But I'm sending you, let's say I give you a loan of $100. I'm sending you that $100 to your checking account. So now it's a deposit or a liability. So I've created an asset and I've also created a liability. And as you can see, this continued to grow until July of this year, where it kind of slowed down. And then in April of 2022, or excuse me, July of 2021, and then sort of like April, June, in and around that area, we've started to see a slowdown. And if we pop on over here and we have a look at the yield curve, we'll have a better idea as to why. There's two different yield curves we're going to look at. We're going to look at the, take that off log scale, and let's compare this. This is the 2-year plus US 10Y minus US 03MY. And what we'll see is both curves are inverted below zero. Notice, there we go. Both curves are below zero. Yeah, both curves, that's the zero line. Both of them are below zero. So banks are not making any money. They're less willing to lend out. And what drives the cycle? Credit expansion. So as of right now, we may go into a recession because why? Because banks are not able to make money. The Fed have increased interest rates too fast. The long end is coming down. So now you've got short end rates too high relative to the long end. You've got an inversion. You've got a slowdown in credit. And now we've got to wait for some sort of steepener. And that's likely to come in the not too distant future, in my view. We're already starting to see liquidity sort of ease. I follow Michael Howell for that. He's been in the business since 1996, manages $1 billion, but he's more focused on liquidity, and he shares an awful lot of information, but he's been really helpful in understanding the turning points for liquidity. I wish I listened to him earlier this year because he's very much bearish, but he's now starting to bend a little bit more to our view. So if we pop on over here, if you guys want to check it out, it's a really good, Michael Howell, this guy here, it's a really good 2-hour Spaces call talking about liquidity, 2023, essentially where we are. Good candid view of what's likely to happen next year. So as you can see, we may go into a recession next year in 2023, but we may also see equity prices recover. Why? Well, liquidity would improve. On the short end, we'd likely see rates come down, and that would obviously steepen the curve again into next year, which would be positive. But secondly, we're probably going to see inflation remain quite hot. So if we look at the latest CPI print, and then we annualize that, we've got, is it 6.3%, 6.5% on an annualized basis for core. Core excludes food and energy. And if we factor in headline, which factors in food and energy, we're at about 3.6%. So you can see that at the margin, energy is going to bring inflation down, but it's still going to be quite elevated. Why? Because of core inflation, which is largely driven by consumption, driven by wage growth. And that's likely to remain into next year. So we might have inflation of like 4 or 5%, something like that. What equity prices react to is nominal earnings, right? It's not real earnings. And that's the mistake that most people are making. You get 0% interest on your savings as of right now, despite where interest rates are, you get 0% interest. But these companies, like inflation is the growth in terms of cost of prices. So revenue's going up. As long as margins are consistent, earnings go up as well. So even if we see real GDP negative 1% next year, we could realistically see nominal plus 4%. And that would translate into positive nominal earnings. So we could actually see nominal earnings grow next year despite having a recession. I don't believe it's going to be very deep because we've got $1.6 trillion in net savings. And as I mentioned before, the consumers delevered. It's only 80% debt to GDP versus global financial crisis was closer to 110%. Problem this time around is sovereign holders. So just to answer this part here, a lot of people ask me, and there was a question regarding how I position into next year. 2022 was a really bizarre year. I certainly haven't invested in any environment like this. Yes, I anticipated the economy to be quite strong, but what I missed was that massive increase in weighted average cost of capital because I didn't believe that there was, regardless of inflation, I didn't believe there was a precedent to raise interest rates simply because when you look at the bond market, if you look at the balance sheet or the forward projections in terms of the income statement for the US government, they're projecting that they're going to spend $1.3 trillion more than what they're bringing in on average for the next 75 years. That doesn't even include debt reduction. That doesn't include interest expense. So they're on top of that again. So the government's going to lose, $2.5 trillion a year in perpetuity from here. So raising interest rates, I think it'll be short-lived, and that's ultimately what my view would be. But you can see that the volatility in treasury markets has spiked massively. And this is why I didn't think there was a precedent for raising interest rates, because volatility within the US bond market has been absolutely massive because there's absolutely funding risks. And so that's what kind of caught me off guard. And you can see it here. There's a lot of instability. This is the ICE, Bank of America, US bond market option volatility. So this is bond volatility. We use the VIX for the S&P 500. We've got the MOVE index for bond market volatility, completely illiquid. This is supposed to be the risk-free rate. This is supposed to be the safest asset in the world. It's underperforming the QQQs. It's underperforming the S&P. It's underperforming the Russell 2000. It's got higher volatility than equities. This is supposed to be the safest asset in the world. So that's why I didn't anticipate, interest rates going from 1.75% neutral rate up to 4 or 5, and they're talking about 5.5%. I just don't think we're going to get up there. 56% of all bonds are maturing in less than 4 years. Like, we're going to re-rate pretty quickly, and the interest expense already is $720 billion. It's a big risk. So there's there's that as well. So I do think we're going to start to see a steepening. Nominal earnings can be quite positive, but as the weighted average cost of capital comes down, I think we might see equities push higher. Now, the caveat to that is that inflation goes negative. I don't believe that that's going to be the case. I think it just cools off. But the caveat to that is that inflation goes negative, we go into deflation. And if we go into deflation, well, then there's a real risk of earnings actually coming down at a faster pace. So that's one of the challenges. But, it really comes down to what your view on inflation is. I think we go from 9.1% peak this year, and I think we average probably 4% or so next year, because the labor market's incredibly tight. It's incredibly tight. So I think that equities could even recover next year with more liquidity flowing into the market, despite the economy weakening. And you might say that's never going to happen, Rob, but we've just seen a really, really, really strong economy throughout 2022. And I know that's not what you hear down at the bar, but we just seen a very strong economy in 2022, and the market's down 18, 20%. Well, it depends on the index. Depends on where you're investing, but the market's down this year despite a very strong economy. So next year, the inverse could happen with inflation, 4 or 5%, interest rates coming down because we have that contraction in loans, as you can see here, and we could actually see a rebound in equities into next year. And that's sort of what my running hypothesis is as of right now. So that's the first part, markets. So yes, I still want to be long. I still want to be long. And again, like the way in which I look at it, the way in which I've always looked at it is, when you're investing for retirement, like 10, 20, 30 years. This is not something that's going to be massively important in a couple of years. As long as you make the right investments, that's the way I look at it. Warren Buffett, people always say, yeah, but Rob, you've had a terrible year. Warren Buffett's compounded for 60 years at 20% per year. But nobody ever talks about 1970, 1971, 1972, 1973, 1974. Over those 5 years, guess how much he made? Zero. And in 1974, he lost 48%. So over a longer period of time, it kind of averages out. So it's not something that I worry too much about. I think the weight of the probability in my view is higher to stay long into 2023. And that's sort of a breakdown of what happened this year versus why the economy was strong, why the market broke down. Next year, we might see an inverse of everything, which will kind of shock everyone, but I don't think anything shocks anybody anymore. Thomas' question, the bond index chart looks quite similar to 2008. Yeah, that's the problem. This is the problem, and nobody understands it. Everybody's looking at the current market and saying, everybody's looking at the current market and trying to compare households. You have to remember, in 2008, global financial crisis, the problem back then was households being over-levered, banking system was over-levered. It was literally the private sector was over-levered, right? And today, it's not the private sector. Private sector is under-levered with a lot of fixed-rate debt. The problem is the US government. And here's where today is actually worse than the global financial crisis. And the reason being is because the world's reserve currency is US dollars. And so all of the, like, you look at what happened with FTX, right? So FTX created this token, FTT, and then they used that as collateral to make loans. But that collateral is not worth anything. So I'll ask you a question. If the US government has debt to GDP of 120% or 121%, and they're planning on spending 2 trillion plus factoring in interest per year in perpetuity more than what they're bringing in, what's the collateral worth? Well, it'll be worth something because the Fed will step in. They'll have to. And it won't be about inflation. It'll be about financial stability. And that's what I think a lot of people are missing about the current market environment. So it's nowhere like 2008. It's in fact way worse because we've got a sovereign that's on the chopping board, which is the biggest problem. That's why I didn't think interest rates would be increased at such a rapid pace. Okay, so next part, portfolio construction. So we always have to ask ourselves when we're investing, should we be active or passive? I've come to the conclusion that active, for me anyway, is a better investment over the long term over passive. And let's start off with passive first and foremost. So passive investing, people think that if I go out and buy the S&P 500 and dollar cost average in, I'm going to make 10.1% on average in perpetuity. And you might, that's a possibility, but as they say, past returns don't equal future returns. So let's have a look really quickly at the S&P 500. Let's put the line chart on here and let's go log scale. So this is the S&P 500 since 1871 all the way into 2022. So this is since the inception of the S&P 500. Okay. When you buy the index, you don't buy 7% of Apple. You don't buy 3% of this. Yeah, it's part of the index. But what you're buying is, first and foremost, you're buying GDP growth. Secondly, you're buying inflation. And thirdly, you're buying operating EFFIs. Whatever, I don't know if that's spelled correctly. Anyway, it doesn't matter. So that's what you're buying. When you make a bet on the index, you're buying GDP growth, inflation, operating efficiencies. That's what you're buying. And that all of that there is a macro bet. And to explain that, like the reason for this massive growth in the S&P 500, it's entirely got to do with them taking the reserve currency status for the world in 1946 or after World War II. And the reason being is the region that has the highest amount of growth, which at the time you had a young population and you had a lot of growth in the United States, the rest of the world is willing to lend the money and borrow them and lend the money and allow them to grow out because they know that they're going to get a return and they're going to get some upside in that economy. So the United Kingdom started to slow down. They pass over the baton. We no longer use the pound as a reserve currency. We now use the US dollar. And what that allows the United States to do is literally borrow money from every region around the world. International institutions and countries, they all start buying US government debt. It gives huge amounts of cash to the US government and they can invest it. US economy grows pretty quickly. So this is the first part of it. And with that, you get inflation. And with that, you get operating efficiencies, more R&D, more capital expenditure, etc. And then you have this boom in terms of earnings. Well, that was in 1946, right? So this was in 1946. Which is right here after World War II. That's when the United States started to take over as the leader in the world, essentially. Well, look at the performance since 1971. So 1971 into 1946, like 70 years. And the performance since inception was 298% over 70 years. It was absolute trash. You didn't make a lot of money. And so as you move forward, if you're making a bet on passive investing, you're betting that GDP will grow in perpetuity as it has. Inflation will be stable at 2, 3, 4% as it has been. And we'll continue to see more and more operating efficiencies. And just to give you an idea of this, we went from mostly industrials to more tech. What does that mean? Higher margins. So where's the next level of efficiencies? Where do margins continue growing out? And these are the challenges with investing in an index. Like people think it's passive and it's super easy because that's what worked in the past. And it worked in the past for the reasons I mentioned a moment ago. But as I mentioned before, it's really about where do we go from here? As long as the United States is the world reserve currency holder, and I think there's probably another decade of that at least, well, then I think that the S&P 500 in US equities is the best place to be. But as we move forward, I'd be less sure of that. Empires don't last as long as a lot of people think. You know, at any one moment, the Spanish were like in charge of the world, the Portuguese, the Romans, you know, the Greeks, the British, you know, even like what's the Mongolians at one point, like under Genghis Khan, had like 1/3 of the entire landmass of the world. They were ruthless. So the empires change all the time. And you're betting that the world reserve currency stays in perpetuity with the United States, and therefore they can keep borrowing at will. GDP continues to grow, inflation, operating efficiencies. That could possibly happen. But what I'm saying is it's not passive, and it's not a case of you know, you just have to sit back and you'll just make 10.1%. That may not be the case moving forward. And as you can see, I'll give you one example here looking at, you know, prior to getting the world reserve currency, there wasn't a lot of gains. And I'll give you another example. And we'll use Spain. So I'm living in Spain, and yes, quality of life here is bloody fantastic, but investing in Spanish equities has been a disaster since 2000. So in 2000, if you started dollar cost averaging and your view was, oh, you know what, equities only go up because they did up until that point. Equities only go up. They only go up, so I'm going to keep investing in it. Well, since 2000, you lost money, even adjusting it for the dividend. Why? Well, GDP growth in Europe was close to zero. You had no inflation, and you had operating deficiencies. Why? Because there's too much bloody red tape in Europe. And so that's just an example. When you're looking at active versus passive, you have to consider when you're looking at passive, it's not a straightforward bet. And I'll show you why I prefer active investing. And I'm not trying to convince anyone like who wants to be a passive investor. I'm just suggesting that there is stuff that you need to consider. If I'm to consider like another company, so in the FDR, this is a Spanish company, right? So let's move this to a new pane above. This is a Spanish company here, and let me turn that into log scale so you can see it. So you have a Spanish company here. It's a company called Fluidra. They sell pool products, but they had operating efficiencies. They were growing on the top and the bottom line, and the market rewarded them while the index was going down. So if you can find good quality companies and you can invest them over medium to long periods of time, like this is like 15 years or whatever, 17 years. And if you can invest in them for long periods of time, it's far better than possibly the index. And that's something that you need to consider. And that's where I stand on active versus passive. So that's obviously a question that you really need to ask yourself. Is it better to be a passive investor or an active investor? But don't fool yourself into thinking passive investing is, I have to do nothing. There's still an analysis that needs to be done there. So just be careful with that. The second thing is what actually drives share prices, right? So for portfolio construction, we want assets that we think can go up. And I should add a caveat in here, like one big part of it that a lot of people miss is time frame, time horizon. Time horizons are incredibly important, and I think people lose conviction very quickly. I learned the hard way. I was invested in a company called Arista Networks. I invested in this company back in 2015, just after they went public. I held it for a year. I think I lost maybe 5%, and I just lost sort of patience. And when I closed out of it, it just started running. And to this day, I just feel pretty disappointed about it. The fundamentals of the business were very strong. There was a lot of negative sentiment. Every position you invest in is going to be negative sentiment. This company, you had two former executives of Cisco set up this company. Cisco were saying that they stole all their IP, and Arista Networks should be a division of Cisco. And that's kind of a little bit of the reason why I sold out. A little bit more naive, sort of insecure about my investing back then. But again, I look back on this and, you know, after an entire year, I lose money on it. And then you look at where it is. If I just bought it and left it alone, so it's a good quality company, 825%. And so time horizon should be in there as well, which I didn't put in. But let's talk about, there's two different things we're going to talk about. We're going to talk about discount to intrinsic value, and we're going to talk about, you know, forward guidance and profitability, which drives share price. And over a reasonable time frame, you should make money. So forward guidance, there was actually a paper written. So let me delete or close loads of these. I don't need them open anymore. There was a paper written in, it was written, does a market over. It was Richard Thaler and Warner de Bont. I think it's this one here. And this paper was written in 1985. And to this day, it's been the best piece of material that I've read on markets. They're looking at what actually drives asset prices. And they go over, like, is it dividends? Dividend investing is a terrible way to approach markets because you're just giving yourself a taxable event. And the problem is the distribution is going to be taxed in income, and that's going to be higher than capital gains tax. So investing for dividends, in my view, doesn't make a lot of sense. If there is a high dividend that comes with an undervalued business, great, but I wouldn't be investing just for dividends. So these guys prove that there's no relationship between equity performance and dividend distributions, only you pay a hell of a lot more tax on that. But what they do find is that equities react to forward guidance. Now, this paper was written in 1985. It's easily, in my view, one of the best pieces written, and they break it all down, all of their hypotheses, and they come to a conclusion that what actually drives asset prices is obviously valuation and earnings. So if we had a situation where, you know, a company is guided for 20% earnings growth, well, we would discount that. And this is why the efficient market hypothesis is total nonsense. The market price will start discounting 20%, but as we get closer to next year, the companies start missing their targets and it's actually closer to 10%. What do you think happens to the equity? Well, it re-rates lower, crashes lower. So what happens with equities, what actually drives the price of equities is actually forward guidance. We discount expectations, and if it doesn't come to fruition, well, then we correct all at once on the downside. And so when we're looking at companies, it's very important that we consider the forward guidance. So I'm going to start off with return on invested capital, just to give you an example. Return on invested capital, essentially, let's go over to Domino's Pizza. A real example, let's have a look at Domino's Pizza here, DPZ, and let's have a look at its return on invested capital. This will surprise you guys. Let's just look at a couple of things here. Return on invested capital, long-term for Domino's Pizza. As you can see, this is not my calculation, but since 2002, you can see 69%, 65, 75, 80, 100, anywhere from 60 to 150%, right? Year in, year out. Well, let's just assume, just for our example, we're going to use $100 in terms of return on invested capital, right? So what exactly does that mean? And I'm going to show you how fascinating it is. And this is just a really radical example. Let's just say the return on invested capital has been $100. Well, in order for me to make $100 next year at 100% ROIC, so the return on invested capital, the rate of that return on invested capital is, where's my at? I've got a Spanish keyboard. So at 100%. So the rate of change, or excuse me, the rate of that return on invested capital is 100%, and I make $100. Well, next year, if I need to make $100, how much of this $100 that I've made do I need to reinvest? Well, I actually only need to reinvest $1. It's a capital-light business. You often hear Warren Buffett say, we should invest in capital-light businesses. What on earth is he talking about? Well, one way in which to measure that could be a very high return on invested capital. We also hear Charlie Munger say, like, the underlying business, the company's only, it's only worth, or its growth is only going to be equal to the growth of its underlying business, right? So a high return on invested capital means that you only need $100 in the following year reinvestment to make 100. And that's the case for Domino's Pizza. Now, this is why it's fascinating. And this is not just specific to Domino's Pizza. I'm going to show you a big list of evidence, essentially, if you will. But let's have a look at Domino's Pizza. Let's have a look at its growth over the past number of years. So let's have a look at Domino's Pizza. Let's have a look at its growth. And as you can see, it's pretty much single digit with a complete outlier at 23%. Low teens, somewhere around 10%, and single digit for many years, right? It's not growing at a really fast pace. What do you think the equity price has done? Since 2009, this is up 85 times more. This is up 126x, 126,000%. Sorry, 12,610%. That's what it's up since 2009. And the top line's only growing single digits. So how exactly does a high return on invested capital with a low growth on the top line equal 12,500%? Well, there's $99 every single year left over in that example. What do they do with that? Well, maybe some M&A, maybe some reinvestment, capital expenditures into maybe new locations, or maybe it's just straightforward buybacks. So if we go to their balance sheet here real quickly and we have a look at shares outstanding over the past number of years, what they've been doing for a lot of the time is buying back their own stock. They've got so much cash because they don't need to reinvest a lot of it. Going back to what Warren Buffett says, asset-light businesses do very well in all market environments. This is an asset-light business. So the outstanding shares has gone from 68, 69 million all the way down to 36 million. It's cut in half since 2006, but it's really accelerated since 2014 when we went from 55 million. So you have all this extra cash left over. It's barely growing on the top line, but it's a very profitable business. What does that equal? Well, if you buy it at a discount relative to its intrinsic value, so if you buy it at a discount with a high return on invested capital, long-term, you make a crap ton of money. And of course, it could be quite volatile, which brings me to the next part. So the next part, I'm going to stop sharing this screen. So I want to give you a little bit more insight into this idea. And return on invested capital is just one metric that we would use. It's not the be all and end all. But what I've done here is, if I zoom in, I've taken every company in the S&P 500 that has a long-term high return on invested capital. So do I have it marked out here? I don't. All of these have greater than 20% return on invested capital. So there's 503 companies in the S&P 500. 119 of them have high returns on invested capital, and these are all of them. So you can see like Apple, obviously Buffett's invested in Applied Materials in the portfolio. We're invested in that. There's a number of companies here that you might be familiar with. Domino's Pizza, Pool Corporation, which we recently bought. These all have high returns on invested capital. And the first thing I want to point out is, let's say we made an index, and let's say we only invested in companies with high returns on invested capital. Now, all of these companies, or the vast majority of them, I've gone through the return on invested capital. And even throughout the global financial crisis, they had greater than 20% return on invested capital. We've seen a moment ago looking at Domino's Pizza since 2000, as far back as the data goes. My camera turned off. As far back as the data goes for Domino's Pizza, it's greater than 60%. So all of these businesses have long track records. I'm not sure why my camera is not working. Let's try again. All of these, one moment, I'm not sure. I don't know why it's not working. I'll turn it off and turn it back on. I'll wait till it turns off. Maybe it'll come back on in a minute. Anyway, I'll keep going before I lose my train of thought. All of these companies are essentially consistent. Like you've got Colgate Palmolive in here, Clorox. You've got a little bit of everything. Cummins, Costco, Copart, Cisco. You've got all these different businesses all growing greater than 20%. And what I wanted to do is, it's very easy to screen out one metric for consistent companies. What would the performance be if you only focused on profitability? Well, if we go down here, we measure the performance. If I invested 100,000 into this basket here of companies, my 100,000 turns into 707,000. It compounds since 2012, which is almost 11 years, at 19.46%. And that's not factoring in the dividend. So some of these companies, such as Procter & Gamble, have a decent dividend. You also have 3M, which has got a 5% dividend. You also have, there's 3M. You also have MO, which is Altria, tobacco company, 7% dividend. So all of a sudden you have a situation where the total return is probably over 20% for screening out the most profitable companies here in the index. So just focusing on return on invested capital, you get rid of an awful lot of the junk. It doesn't mean that every single company is going to perform very well. So of the 119, 26.89% of these didn't perform well. There's 32 of the 119 that underperformed the S&P 500, but 73% massively outperformed. Here's the catch 22. Outperformance comes with higher volatility. And that's what most people are not willing to accept in markets. Everybody wants low volatility, high returns. Doesn't exist. So what I've done is I've just taken some of the outliers just randomly, like anything that's way above the market. So the S&P 500 was 12% over that period. This portfolio is 19% over that period. So you have like Apple here at 23.44%. So far off its all-time high since I took this about a week ago. It's negative 23%. You got Adobe negative 53.4%. And even with that, it's still compounded since 2012, 23.89, 36, 42, 23, 34, 54, 30. These are all way, 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 way bigger drawdowns. 53, 44, 44, way bigger drawdowns than the S&P 500. So this index, despite being twice as good as the overall market, it's probably down about 1.5 times what the S&P 500 is. A lot of these companies that have compounded, these are the larger weightings. Like Nvidia has compounded at 42%. This would be a larger weighting within the index, and it's down 50%. And you can see like 39,000 is probably like 4 or 5%. It's pretty decent sized position. So this index is probably down somewhere between 30 and 35%. What I'm trying to point out is to get these higher returns, there is going to be more volatility. And that's just part of the game. More volatility equals higher returns, lower volatility, lower returns. And that's sort of just how it works. But I wanted to kill two birds with one stone by showing that, look, these companies are good quality. They've massively outperformed over long periods of time. You can go back further than 2012, and they've still massively outperformed. And massively outperformed the S&P 500, but there's a lot of more volatility along the way. Is there anything else I wanted to point out? Probably like we're going to look at Fortinet in a moment, 3M, we're going to look at that in a moment. So just to let you guys know that this is part of that basket. It has underperformed so far. It is a potential acquisition for us moving forward. It's been in a 4-year bear market, but we'll look at that in a moment. Okay, let's pop back on over, unless you guys have any questions. I don't know why that's not working. Anyway, I'll try and fix it now in a second. I'll plug it out. I'll plug it back in and see if it works. Problem is it's a DSLR. So let me just plug it out and plug it back in. Yeah, I don't know. That's a pity. I don't know what's wrong with it. I don't know why it's not working. Anyway, it doesn't matter. It might come back on in a minute. Remove from stream, solo. Sorry about that, guys. I don't think it's that important, but it's more personable if you can see my face anyway. Anyway, maybe I'll turn it off for a minute. Maybe it's a little bit overheated. I'll take it out for a second. Now it's not coming up. I don't know. I don't know. I'll just Can you guys hear me? Can't hear. This is shocking. You still can't hear? You can't hear? Oh, okay. You guys can hear now. I have no idea this has never happened with this app before. This is using StreamYard. This has never happened before. So I don't know. Can hear you now. Okay. Okay, Raz, thank you very much. I hope it's working now. Sorry about this, guys. This has never happened. I apologize about this. I'll try and figure out what exactly is going on after. Let's get straight into it. What we're going to do to understand the intrinsic value is we're going to calculate its discounted cash flow model. Now, it's important to understand what a discounted cash flow model is. So I'm going to give you a high-level view of what exactly we're looking at here. Get rid of it. We'll try and reload it. Sometimes Google Finance is a little bit slow, and there's nothing wrong with that. We just have to reload it. So why is the current price not coming up? Control Z. Maybe if we just reload the page. Okay, so what we're looking to do is, as we mentioned at the very beginning, there is a string of cash flows that a company makes. We're going to look at it as EBIT, right? So earnings before interest and tax. However, we need to understand what the unlevered free cash flow is, and we need to understand what we need to discount that by. So as we mentioned earlier, we want to discount it to the level at which the weighted average cost of capital is, because that's what the cost of capital is every year. It's not worth the same amount every single year. So when we're looking at our discounted cash flow model, we're anticipating what the forward earnings is, minusing out the tax rate, adding back depreciation, which is a non-cash expense, excluding out our capital expenditure, and then we have to adjust for working capital. So if we're to look at the changes in working capital, this is what an awful lot of people miss. Working capital is the difference between current assets and current liabilities. So if you've got tons of inventory, over the next couple of years, you're going to deplete that inventory. So your working capital is going to go down. So that's going to add to your cash flow as you move forward. And if you're going to rebuild inventory like what we've seen over the past couple of years, well, that cash flow might actually increase. And so changes in working capital are very important as well. And that gives us what's known as our unlevered free cash flow. However, we can't just look at this and say, let's multiply this by 10 and then therefore we have a valuation. This here has a discount rate and it also has a residual value. So the residual value of the business. So what we need to do is we need to calculate all of our unlevered free cash flow. We need to understand what our weighted average cost of capital is, which is still loading. This sheet has got like 400 different tabs open. So it's a little bit it's a little bit slow, but we'll try, and if not, I'll just input it manually for right now. We can go WBD for price. It's currently trading at 11.09. So we can just put that in manually for right now. And so that's the current price. Shares outstanding should load up. If not, we can just pull them. It's not a problem. We can just pull them from here. So I'm trying to pull it from Google Finance. Reload, force reload. We can just pull it for right now. So there's 2.428 billion. 400 million. So we've got 2.4 billion shares outstanding. Price, we need to make an estimate on its expected tax rate, which is fairly easy. Its discount rate, which is its weighted average cost of capital, as we mentioned earlier. Each business has got a different capital structure depending on its debt and its equity. We need to understand the cost of equity. Why is the beta not loading? I can just pull this there it is there. So the cost of equity in this case is 11.07. Interest rate, the tax shield on that interest rate, and then the cost of debt. And then we blend them based on the percentages. We get weighted average cost of capital. So we take that weighted average cost of capital and we discount unlevered free cash flow as we move forward, because these cash flows are worth more today than they are in the future. And then we need to understand what its essential residual value will be at the end of it. So there's two ways in which we can calculate the value in order to consider the intrinsic value. So the intrinsic value takes into consideration all of these coupons, including its terminal value. So in order to understand the terminal value, some people use the perpetual growth rate model, which considers the difference between weighted average cost of capital, perpetual growth, which is GDP growth of assumed 1.5%. And it considers also the unlevered cash flow here into 2026 relative to the difference between discount rate, perpetual growth rate. And it gives you a valuation. So if we're to use that method, it'll give us 263 billion for enterprise value. There's another way, which is looking at enterprise value to EBITDA. So we take the multiple of enterprise value, which is 11, and then we look at EBIT, and we multiply 11 by EBIT plus depreciation and amortization, and that gives you another way of valuing it. But look at the discrepancy. Now, if I want to be very favorable, I would only look at the perpetual growth rate model, which would give me a target of $87 on the upside, which is not really fair. If I'm to use enterprise value to EBITDA, it'll give me a target of $40 on the upside, which is probably a little bit conservative. So normally what I do is I get the average of both of those, which is 205 billion, and then I factor that in as the terminal rate over here, and that gives us a target of $61 on the upside. Now, we're currently trading at 11. My target's always been up around 70, in and around that general region. And this really confirms it. So now that we understand what the intrinsic value is based on all these estimates, and where these estimates came from it came from Ticker Terminal, but where they come from on Ticker Terminal is we've got a valuation, and we pop on over here to Street Analysts. There's 18. So as of the 22nd, there's 19 different analysts that all they do is try and figure out the revenue growth, the bottom line earnings, the capital expenditures. They're on the analyst call asking questions, trying to come up with estimates. There's 19 different estimates, and the consensus of those 19 estimates is what I've inputted here. And so there's a lot of analysts that are trying to figure this out that are going to do a better job than I am. Not perfect, but going back to this idea here that markets discount future expectations, and if it doesn't materialize, well, then we correct lower. But if it does materialize, we continue rallying. So I think that those estimates are reasonable across the board. I've taken everything in terms of estimates: EBIT, depreciation, amortization, capital expenditure. Changes in net working capital is a little bit more of a guess. 2022 has already happened, but then I'm assuming just a negative $1 billion moving forward on average per year, but it could be a lot higher. That leaves us anyway with 61.58. So let's pop on over to Warner Bros. Discovery. Let's talk about the opportunity. The opportunity has actually changed since I bought it. And so I want to talk about this a little bit more in detail. So going back to that idea, we've got a return on invested capital, which is one way of looking at profitability. In this case, it's more special situation because it was a reverse Morris trust. And then another way, if we can blend the two of them, looking at a discount in intrinsic value, and I'll explain why I think the discount is so much here on Warner Bros. Discovery in a moment. But right now we're trading at a massive discount where there's potentially 455% on the upside, or even, somewhere between 250% on the upside, just to get back to the lower estimates based on 2026's cash flows. So let's have a look at the opportunity that exists. This year is a little bit difficult to look at it. If we look at the EBIT, negative 4.6 billion, not a fair reflection, as you can see from its unlevered cash flow, because depreciation and amortization is a non-cash expense. That's 7.5 billion. Capital expenditure was wound down 2.5 billion or so. So that was down to 953 million. And the changes in net working capital after the restructuring, asset write-downs, etc., was 9 billion, leaving them with 11 billion in unlevered free cash flow. So when we're looking at the business, this year is going to be a total mess. Next year is going to be a bit of a mess. It won't be till 2024 where you actually look at the numbers and you're like, wow, this is a very profitable business. But that's why investing in it today, in my view, might make a little bit more sense. I'll talk about as of right now where sort of the lessons learned in this and why I decided to increase the investment. But asset write-down, restructuring, and layoffs after the merger, there was a lot of changes that happened that even Zaslav himself didn't realize. There was a lot of challenges with vanity projects, overspending. This was a business that was previously spending $2.5 billion to make $2.5 billion. And when Zaslav took it over and looked at all the books, it was a business that was spending $7 billion to produce $3 billion. Not very good economics, terrible. So there had to be a number of asset write-downs where there was far too much goodwill, restructuring in terms of shutting down vanity projects, laying off staff, etc. And that's what we're going through at the moment. The core business is looking at about 7 to 8 billion in free cash flow. They have 50 billion in debt, 26 billion in equity. So the enterprise value is 76 billion. It seems like a lot, but we have to factor in that the average maturity is 14 years and the fixed rate debt is 4.3%. They're paying down $2 billion per quarter in debt. So the debt reduction should be pretty aggressive. Zaslav has already done this. Discovery went into an M&A deal with Scripps, and it was 5 times leveraged. Net debt to EBITDA was 5 times leveraged, and they had to delever, and they delevered in 14 months. So he's done this before in terms of debt reduction and cost savings. The revelation that we've seen and why the opportunity is different today is that previously they wanted to compete with Netflix. That's terrible writing, but that should be Netflix. What Zaslav has realized is Netflix has already dominated the global market, unfortunately. They've got too much of sort of investment in local markets around the world. A lot of movies being made locally in the UK, France, parts of Latin America. It's capturing local markets. They still have an awful lot of licensed material. You look at Paramount, they're still licensing content over to Netflix. And so they've kind of dominated most geographies. It would require Warner Bros. Discovery at this stage to reinvest a lot of capital, which they're kind of constrained in doing, which means that HBO Plus would have to sort of wind down to more of a niche player. What does that mean? Well, Disney is a niche player. It's focused towards kids. And they've got over $100 million in subscribers. So it doesn't mean that they still can't reach high numbers. But what it does mean is that the 200 to 300 million subscribers that they were guiding is probably not on the table. What's likely on the table is, as they've guided 130 million subscribers. So there's the expectation in terms of the growth has come down. But as Malone said, with the change, John Malone I'm talking about, with the change in direction, the scale back and the focus on niche, they're clawing back about 3 billion. John Malone suggested the synergies could be as high as 5 billion, but they're clawing back an awful lot of that capital expenditure because they're not going to be competing. The business will still spit out a high amount of cash flow, a huge amount of cash flow. I was expecting 11.4 billion in 2026 anyway. And even when you adjust the numbers to factor in EBIT growing a lot slower and the much slower amount of cash flows, capital expenditures, you're still in and around the same ballpark. So it's a different vision, but it's an easier target and a blend of advertising, sort of like a hybrid blend of advertising and direct consumer subscription models should be able to give them an awful lot of growth as well. So this is a business that's paying, just to give you an idea of how this could grow. This is a business that's paying down $2 billion per quarter in debt, about $8 billion per year. And they have the capacity to keep doing that for quite some time because they actually do have a lot of free cash flow, unlevered free cash flow to do that. And so $8 billion per year, if you can imagine, like you look at enterprise value to EBITDA, the way in which we measured it, we're not factoring in debt reduction. But if you look at this, if you look at the way this balance sheet looks, sorry, I'm just going to Control Z, it's a lot easier. If you look at how this balance sheet actually looks, you have $50 billion in debt, $26 billion in equity. Now, if the debt is reduced into 2025-26 by 25 billion, which is highly possible, and the fair value is somewhere closer to 200 billion, well, it's the equity that needs to be adjusted higher, not the debt. So $175 billion would be equity and $25 billion would be debt. So there would be significant upside for the equity in this circumstance. And so I still see it as massively undervalued. So why exactly did this get absolutely pummeled? And what are the lessons that we learned? And why did I add some more? Well, I added some more because I think that, when we're looking at a discounted cash flow model, these are great. They give us an idea of what fair value is. But at the same time, although it gives us an idea of fair value, at the same time, it's really important that we take a step back and realize that This is still a guesstimate. It's just a sort of, people always say, Elliott wave is like, it just borderline deceptive, I think is what I heard recently. But at the end of the day, I mean, if I'm to guess what next year's net income is, isn't that the same thing? Just guessing what the number is. And so there's an element of that you need to factor in. That's why there's a high fail rate. We're guessing what the future is likely to be. That's why there's a high fail rate in equities. But you got to analyze the business, and you got to ask yourself, okay, is that $61 achievable? Well, maybe $61, like I think it's worth 70. I still think it's worth that. But maybe even if we didn't hit $61 from 11 up to 30, would that be a good return into 2026? I think that would be a fabulous return, 200% in the next 3 years. So we got to look at where the asset's trading today and what its opportunity is over the next number of years. And even in worst case scenarios, I think it's deeply undervalued. So how did it get deeply undervalued? Well, let's have a look at volume here. So this went through what's known as a reverse Morris trust. A reverse Morris trust essentially means that if you have one business over here and they have a part of their business that they'd like to spin off, but they don't want to pay tax on it, they can spin it off to a currently existing entity. The entity has to be smaller, so that could be spun off, and it can be tax efficient, so no taxes paid. But the caveat is that these shareholders, so these guys over here that own AT&T, have to be the largest owner of this new entity. And the entity that was standalone was Discovery. And Discovery shareholders got 29%, and AT&T shareholders got 71%, right? So that was the breakdown of ownership in this new Warner Bros. Discovery. So these investors here are dividend investors mostly. Again, I don't agree with that income sort of seeking investment strategy or whatever. There's a lot of pension funds and whatnot that require that dividend. And then they receive a dividend as equity shares that doesn't pay out cash flows. So in a falling share price environment, what do you think is going to happen? Well, in hindsight, I can tell you what happened, but I didn't notice in real time. In hindsight, I can say that volume increases. This was the point at which the deal went through. At hindsight, look what happened. Volumes massively increased. Falling share price environments, a death spiral in the stock. I didn't realize that. I've never been through one of these before. I just knew that it was worth a lot more than what I paid for it. So I got to take a step back and say, okay, it's at $11. Has the fundamentals changed? Okay, it's a different story. It's a different fundamental case, but I can still see a path forward towards those fair values, $60, $70 plus. So what do I do? Well, if the fundamentals haven't deteriorated, and I don't think that they necessarily have over a longer period of time, because of the fact that it's fixed rate debt at 4.3%, and here's the caveat. If you take next year's debt levels and you factor in the estimated interest expense, it's down to 4.13. So as of right now, they've got fixed rate debt, average maturity 14 years. They're paying down $2 billion a quarter. They'll be able to pay down that debt aggressively. And we've already seen studies done on Netflix that show when the economy starts to slow down, revenues for Netflix are very sticky. And we can see that ourselves. If we really wanted to do a very basic analysis, we could go over and look at the number of subscribers to Netflix. 2015, 2016, we were looking at data earlier where we could have been in a recession. And guess what? There was no contraction in terms of numbers, because what ends up happening is discretionary spend starts to slow down, absolutely, but people spend more time at home. And because people spend more time at home, they're unwilling to let go of those subscriptions. TV, it's like a small coupon to pay for at-home entertainment. There is a study that's done on Netflix specifically, and I would assume that Warner Bros. Discovery falls into that category as well. So ignore the Elliott wave and all that sort of stuff here, but focusing on the fundamentals, that's essentially what we see. So I've watched this go down in sort of amazement, but it's also a learning opportunity. And at the same time, it's also an opportunity, if the fundamentals haven't changed, to add a little bit more. So going back to this view here, what drives share price? Discount intrinsic value and cash flows, as well as that profitability and superior business models. So as of right now, when we're looking at, we could work back and figure out what the return on invested capital would be for Warner Bros. Discovery based on these numbers. And we would break even in terms of return on invested capital being above the weighted average cost of capital in 2024. But if debt starts to reduce, interest expense, which is over $2 billion, comes down with that debt reduction, well, then the earnings go up and the return on invested capital will start expanding. So as of right now, the return on invested capital looks ugly. But as we move forward, because we look at the return for return on invested capital, we look at net income adjusted for tax. So we are net operating profits adjusted for tax. And so as we move forward, that return on invested capital will get better and better, but it's trading at a massive discount. And I think part of the reason for that is the reverse Morris trust and a couple of challenges and uncertainty regarding the business, but that's mostly in the rearview mirror. And I'll also point out that if we have a look at this article here, which came out yesterday, annual changes to the NASDAQ 100, we have an addition of Warner Bros. Discovery. 6 companies are going to be added to the NASDAQ 100, the QQQs. Let's have a look at the tracker fund here. The tracker fund has, this is QQQ, by the way. The tracker fund has 154 billion in AUM. So if they have a 1% allocation, that's $1.5 billion that needs to be invested in Warner Bros. Discovery starting next week. What does that mean? Well, it's about 6% of the entire market cap that's going to be net, if that's only a 1% allocation. So there's a lot of stuff changing for Warner Bros. Discovery that led me to this view that it made sense to add a little bit more. And I'll continue to add more and bring that cost down in and around this area. So Warner Bros. Discovery, going back to what drives share price, discount fair value, return on invested capital, and then just be patient. And using Warner Bros. Discovery as an example, which we just added to recently, and I might increase the position again, fundamentals haven't changed. Rare opportunity after a reverse Morris trust where it's gotten beaten down way below its fair value. And so as of right now, I felt like that was a good opportunity to swoop in and add a little bit more. So that was Warner Bros. Discovery, and that's ultimately how we look at what drives share prices: discount to fair value plus superior business model that spits out more profitability. And we use return on invested capital as the example, but we also got to look at efficiencies from an operating perspective. So we got to look at turnover for asset turnover, inventory turnover, working capital turnover. We got to look at all these different metrics, understand the business is good or bad and whatnot. And then if it passes the smell test, we buy it. Doesn't mean that the stock's going to go up right away, but we've got a good probability over a couple of years that it's going to go up. And that's a good segue into the next part here, which is talking about diversification and efficient frontier. So diversification is something that I champion anyway. And the reason why I think it's really important is, look, I think anybody that's honest with themselves has made a gazillion mistakes investing. And if you put all your eggs in one basket, like you look at, I'll give you an example here, CAS 13F filings. CAS is Clifford Soson's fund. These had $2 billion in AUM. If you look at the holdings, very concentrated, 5 companies. But look at the companies like Carvana's gone bankrupt. He just doubled his position at $77, doubled his position. This is a guy that massively outperformed the markets. Way too concentrated. I would say that there's a lot of ego in this, because to put like 46% into one company, in my view, suggests that you know more than the market does. And the problem is when you're wrong, like in this case with Carvana, you're really wrong. And this has gone from $77, I think it's trading at $4 at the moment. So you're down 95% on 25% of your portfolio. So concentration, I've never been a fan of it. And over the past number of years, I've been watching these guys. This guy had, Cliff Soson, I think, had like a compounded growth rate of like 35 or 40%. Just phenomenal for like 10 years until that 1 year where things don't go right for you. And then your portfolio's down 70, 75, 80%. Your business is destroyed. This has gone from 2.2 billion in AUM. And as of right now, there is what's left. Well, that 138 million is pretty much gone. HGV, I don't know where it is, but look, there's 250, 400, there's 500 million there. But as of right now, today, when you look at Carvana, CVNA, if they didn't close it, this is trading at $5. And so what I'm trying to say is I'm not a fan of concentration. I think it's a big mistake. And you can be concentrated and be right for 10, 15 years. And then maybe on that 11th or 16th year, you end up like what unfortunately happened to Cliff Soson, for like whether it was his own fault or not, it doesn't matter. The fact of the matter is you have one bad year in a concentrated portfolio and you're wiped out. Your business is gone. And so diversification, what it allows for us to do is it allows us to split up our bets. There's thousands of companies out there, and you can find like I just showed an example there where we just screened out the performance of 119 different businesses with high return on invested capital. And what we find is that they outperform the market significantly. The performance over 11 years is double, right? 366,000 for the S&P 500, 707 for just a basket of companies without any regard for valuation, just high profitability that outperforms. So you can find a lot of good quality companies in a diversified portfolio. So what we're going to look up now, so that was, yeah, the efficient EFFICIENT frontier. I'm just going to show you guys an image here. You don't have to understand how this works, but this is essentially what the efficient frontier is. You're measuring the point of maximum diversification. So this is kind of like a chart. You can measure this out yourself. It's kind of like complex equation. To be honest, I don't think there's any value in actually measuring it yourself. The value is in understanding what it means. And there is a number of examples you can find on YouTube. And I think there's even studies done on white papers like this one here, which break down the efficient frontier. And they come to the conclusion. So basically what this means is, see that blue line? That's the efficient frontier. And when your stocks are clustering close to that line, it's the point of maximum profitability. And they've come to the conclusion that the more companies that you're invested in, let's say you have 100 stocks in your portfolio, you're less efficient. So longer term, that's going to be a drag on your portfolio. The efficient, anything above 25 to 35 positions, it's really too much diversification. Anything that's less than 10, I think it's too little. So the sweet spot, in my view, would be somewhere around 20 to 25 positions. And I think it's very important to recognize sort of like the mistakes that can happen in investing when you get too concentrated. And I think that's where most people go wrong. They believe they're smarter than they are. Investing has a high fail rate. 25 to 35 positions, some will go wrong, and that's perfectly fine. But net over time, the portfolio itself should do reasonably well. And here's the thing. This is another thing that's kind of interesting. Let me see if I can find it. I've done a portfolio on YouTube before. Let me see if I can find this, a GARP portfolio. And this was down as much as 40%. I haven't done anything with it. I still follow it, but I closed it off because people were editing it and changing it, which bugged the hell out of me. Because every time I went in, it was changed. But this is a portfolio that's down 24%. Well, there's, 24.31%. And some of the positions are down as much as 64, 50, 47. Some of them are up 36. But on average, there's 20 companies in here. Reasonable diversification. This was down as much as 40%. Buy it, set it, forget it, leave it alone. Yes, you're going to have some that massively underperform. But on average, the portfolio should do significantly better than your worst performer and a little bit worse than your best performer. Like, you're getting the average. As long as you're not over diversified and you're somewhere closer to that efficient curve there, you should be fine. And so that's sort of what my view is on diversification. I think diversification is very important because there's a high fail rate. So when we look at the portfolio as of right now, I think there's 22 positions, 21 positions in and around that region. And maybe we could have one or two more, or one or two less, but it's in and around that sweet spot. So that's ultimately why we have that number of positions and what we're optimizing for: discount intrinsic value and profitability. And then we're giving ourselves 1 to 3 year time horizon, maybe more if it makes sense. Some of the positions are heading for 3 years as of right now. Overstock's been there since November 2020, really since the beginning. There's a couple in there anyway that are heading for 3 years now in the portfolio. So the next part is what changes have been made? Where did the 10% come from? Well, I invested in the Taro company, and I invested in the Taro company in anticipation of sitting in this for a number of years. But the thing was, the Taro company has, like, we'll pop on over here and have a quick look at the Taro company just to show you how it found its way into the portfolio. Obviously, it was trading at a discount relative to its intrinsic value. We had a situation where we look at the return on invested capital, long-term history of being very profitable business consistently. We have a situation where the valuation was below its averages. So we have everything that we're kind of trying to screen out, the Taro company had. But a lot of companies haven't recovered. And we're going to look at 3M in just a moment. A lot of companies haven't recovered, and this recovered very quickly. It was up 30 to 40%. It was 5% of the portfolio, and it delivered a reasonable return. It was above its fair value, both on an intrinsic value basis, both on a near-term forward price earnings basis. It was above its fair value over a long period of time, delivered a lot of returns, and I felt like it would be better to rotate that into a different company. And so the Taro company was closed out recently. That was about 6%. Nucor was closed out, which was about 4%. And Alcoa was closed out. Some of that money, 2%, went into international distribution services, which we'll look at in a moment. And some of it went into Warner Bros. Discovery for the reasons I mentioned a moment ago. 1% and 1%. So the reason why I closed out Nucor and Alcoa, and I also actually closed out half the position in MI Homes, I think that if we do start to see a little bit of a slowdown in the economy, probably a little bit too much concentration to the real estate market for now, I do think that's going to be a fantastic area, but I'm going to manage risk in the near term. Nucor has a lot of exposure there. MI Homes has a lot of exposure there. So MI Homes. MI Homes has a lot of exposure there as well. And so I scaled those back for those reasons. We made, I think it was about 40, I'm not sure. We made a good return on Nucor. We made 10% or something like that on Alcoa, not great. And I think we lost maybe like 3% on the half position we closed in MI Homes. So fortunately, 3 of the 4 returned some money, but now we have a problem to allocate that capital. As I mentioned a moment ago, part of the money went into Warner Bros. Discovery, and after an hour and a half, we're finally getting to what the question is about allocating that capital. 1% went into Warner Bros. Another 1% went into international distribution services. I'm looking at 3M, Fortinet, and there's a couple of other positions that we're looking at the moment as well that I'm still kind of working on. So let's talk about international distribution services. I'm constantly looking for new additions to the portfolio, but it's always important to revise over what's actually in the portfolio right now and consider, will I get a better opportunity elsewhere, or should I just increase this position? I understand the company very well, and it's now trading at a deeper discount. Maybe I should buy some more, and that would be more rewarding as we move forward. Or should I allocate that capital somewhere else? So I came to the conclusion that, Warner Bros. Was probably a good price to allocate more capital, and international distribution services, which is Royal Mail, they changed their name, was probably a good investment. So to add some more. So let's talk about IDS. So as you can see, they changed their name. So let's go over what's happened recently. Why did the share price sell off? Well, it sold off mainly because of strikes. But let's look at this, right? So name change. The name change happened. And this is really important. It's really important to understand what's going on at this company. Really, really important. Because then you'll begin to understand why this bottomed, even though they made a net loss and cut their dividend. If you understand what's going on internally, you'll begin to understand the opportunity that actually exists here. So there's 2 different areas of the business. One is Royal Mail. That's UK based. And then the other part is GLS, which is international. So there's two different profit centers for this business. Now, this is what happened this year. Inflation increases in the UK. Royal Mail increases costs, but not enough. There's some challenges. At the same time, you've got increased costs due to strikes, and it impacted the business on the latest quarter. And that's ultimately why they made a net loss for the year for £90 million. The 7 strike days alone cost them £100 million. So Royal Mail is currently a pain in the ass for investors and management because of these strikes, which we're going to talk about in a moment. On the other hand, you have GLS. GLS is running like a well-oiled machine. It's delivered 403 million euros in profits this year, which is about 350 million pounds. We're going to have a look at it in a little bit more detail in a moment. They passed on higher costs. There's no issues with unions, anything like that. Their business has adjusted really, really, really well to inflation. So there's 2 completely different worlds here inside the same company. So now let's talk about the issue with unions. So the unions in the United Kingdom want Royal Mail to increase the wages of Royal Mail staff. And what Royal Mail are saying is, listen, our margins are wafer thin. We can't increase wages because the economics of this business don't make sense. We have to fire people, and the labor unions are not accepting that because they're saying you have 1.2 billion in the bank, you're producing tons of cash, and therefore we've got plenty of cash to raise the salaries. This is really important. It's really important to understand this because on the latest quarter, this is where everything starts to make sense. A director comes out and says, we're pretty pissed off with the unions. They can either bugger off, or we're going to spin Royal Mail off into a completely separate entity, and we're just going to get rid of it. We don't need it. It's costing us a lot of money. It's actually costing us money. It's not making us money. And we'll just focus on GLS. And that's what we're going to do. And so the question becomes, what's the residual value of Royal Mail? Do they even need any money for this to make sense? Could they give it away? Could they just take the keys of Royal Mail, give it to private equity and say, do your best? Could they do that? So that's where we are as of right now with regards to Royal Mail. So again, these discounted cash flow models, they really help us understand all of the challenges that are going on internally in a business, because there's a lot of stuff that goes into these sheets, everything from projections, weighted average cost of capital, debt, cash, all of this sort of stuff. These are all considerations here. So when we're looking at this here, this is important. GLS's net income is £347 million. So the enterprise value of the business, because they've got 1.2 billion in cash, they've got just shy of 900 million in debt. So the enterprise value of the business is actually 1.69 billion. Enterprise value divided by just the net income from GLS has got an enterprise value to net income of 4.87. It's actually cheaper than the business as of right now. Why? Royal Mail is a big, massive drag on the business. So tomorrow, if they just literally gave the keys away to Royal Mail, some of that debt will go with it. Maybe some of the cash for operating reasons will go with it. But an awful lot of the capital expenditures will go with it. An awful lot of maybe some of the depreciation as well, and changes in working capital will go with it. But essentially what I'm saying is, if we just gave away Royal Mail, this business is trading at 4.87 times enterprise value to net income at its current valuation, assuming we got nothing for Royal Mail, assuming Royal Mail was given away. And so when the market began to realize, when the director came out and said, look, we're just going to spin this off and get rid of Royal Mail, and you guys can do whatever you want with private equity. The private equity are probably going to fire 70% of the staff. They're probably going to cut back a number of the routes, and then they're just going to gut the business. Because here's the thing. Here's the problem with Royal Mail right now, which the unions, the dum-dums over at the unions don't realize. They're losing market share. So they're going to have to fire people. It's just very uneconomical. And so the minute that happened, what ended up happening was the share price actually bottomed. This was down massively on the day, and then it just started rallying aggressively because the market began to realize if you gave Royal Mail away for free, GLS is still very cheap. And that's kind of like, again, these two are very like odd scenarios, Warner Bros. And IDS. They're kind of odd scenarios because you got a reverse Morris Trust on one hand, and on the second hand, everybody's blending the two businesses together with Royal Mail. And I think the director coming out recently and saying what he said gives a little bit more clarity on the opportunity of the business. They've lost their patience. So this year, the business, despite Royal Mail, despite GLS generating £347 million, the company lost in terms of EBIT £90 million. So obviously they don't pay any tax on a loss. Depreciation added back 405 million in capital expenditure. Changes in working capital increased 25 million. They still had unlevered free cash flow of 33 million pounds. Not great, but all of that was largely got to do with strikes and Royal Mail. 100 million pounds alone of expenses happened on literally 7 days. So when we're looking at, as we move forward, next year, this is a pretty rough year. GLS operate in Europe. Pretty rough year for GLS. They still maintain their net income for next year. And as you can see next year, if they were to just be flat into 2023 in terms of their net income, they've been able to pass on higher costs. Their business is a well-oiled machine. We'd be looking at a higher EBIT, right? So this is net income. This is adjusted for tax. So the EBIT would actually be even higher than 347. So next year, we're anticipating Royal Mail to impact the business a little bit further. So even with considering these numbers, this is factoring in a drag from Royal Mail. If we got rid of Royal Mail, these numbers might actually look a little bit better as we move forward. But anyway, let's just factor in these estimates. So the enterprise value, the intrinsic value comes in at $7. Again, they've got plenty. Most of the reason why equity prices go to zero is because the balance sheet's not clean. But in this case, it is very clean. And again, if you understand what's going on, you'll begin to realize the challenges, not the challenges, but you'll begin to realize the opportunity that exists here. So as of right now, the equity value of the company is $2.12. That's what I added to it on Friday, $2.12. And the intrinsic value based on the coupon of cash flows, once we get past this issue with the unions, the intrinsic value, the market will start pricing it correctly, is up around $7.06, factoring in a discount rate that's very high of 10.66%, and a multiple, enterprise value to EBITDA multiple of 5.3. And what's interesting is, it doesn't matter which way you calculate terminal value, whether it's perpetual growth or enterprise value to EBITDA, both of them are in the general vicinity of each other. So in both circumstances, it's looking like the stock is deeply undervalued. And so I can look elsewhere for a business, another opportunity. But inside the portfolio, some of these companies are deeply undervalued with fantastic upside opportunities. So that's where I wanted to look first, is what do we currently have and what could we average down on that we could take advantage of over the next couple of years? Because here's the thing, into 2026, right now our average cost from Warner Bros. Discovery it's a little bit higher than what the portfolio suggests. It's $23. So if this ended up hitting a target of $61 into 2026, I mean, we would end up with, we're in this CAGR calculator. Let's just see what the compounded growth rate would be into $40, which would be the lower bound. So our average cost would be 23. Ending value would be 40 on the lower end. And it would be 1 year plus, we got 23, 4, and 5, and then 6. So 5 years we calculate. On the lower end, it's still compounding at about 11.7%. At the midpoint, that's assuming we don't add a little bit more. If I add another 1% of AUM, which is what I'm considering, that comes down to 21. So that's assuming I'm not adding any more. At the midpoint, $61 over 5 years, we are looking at 21% compounded, which is what our target is. Now, I can add a little bit more and get that average cost down. And I think I think $61 is achievable, and we might even overshoot to that 87. Who knows? But I do think those targets are absolutely reasonable. So as of right now, it's very easy to, again, when we look at the market, everyone looks at the market and says, we're in a recession, but that's not the full story. Everyone looks at Warner Bros. Discovery, it's going bankrupt. That's not the full story. There's $11 billion in cash flows there, but there's a lot of challenges with market mechanics, for argument's sake, how the shares are distributed to AT&T shareholders. Like, all of these different things have to be considered. And so as of right now, it's very easy to say the company is not a good quality company, but that's our alpha on the upside over the next couple of years. And that's sort of how I'm looking at these companies. With distribution services, Royal Mail, I may add, it's not as big a position. It's less than half the size of Warner Bros. But this is another one that I think we still have an opportunity to add some more capital to at these prices. Our average cost is $292. I could probably get that down somewhere closer to $265, $270, in around that general region. And then you look at the compounded growth rate. So we bought that earlier this year. We don't even own it. Let's just say it's 5 years as well. Our average cost is currently $292. We get up to 7, and let's say, 5 years, 19% compounded over that period. And so the compounded growth rate from here is actually far better. So if you look at Warner Bros. Discovery, and this is the consideration that we need to make, Warner Bros. Discovery is trading at 11.09. So if I put my money somewhere else, right, this is the hurdle rate that I have to hit. Let's say we only get 40% from here over a 5-year period. That's 30% growth. It would actually be a 4-year period, not 5, because we've already held this for a year. But that's a 37.8% growth rate from here. So that's the hurdle rate if I'm to invest in another business. And that's sort of how I'm looking at allocating the 10%, is what's in the portfolio? Has the fundamentals changed? Like with Zillow, the fundamentals changed. You had to get out of it. But what's in the portfolio right now? Has the fundamentals really changed with Warner Bros. Discovery, international distribution services? It's a slightly different story behind it. But in both circumstances, it's very easy to see how we still get the same outcome. And so what should you do in that environment? Well, it's an opportunity to build out the position a little bit further. And again, we'll have some near-term catalysts with the addition into the NASDAQ 100. QQQ is 150 billion. That's about 6% of its entire outstanding shares. So we'll probably get a bit of a bump next week. And any tracker fund on the QQQ will also have to buy it. And so you look at what's in the portfolio first and foremost, and then you consider whether it is it's a good buying opportunity or not. And I came to the conclusion on Friday that IDS was definitely worth adding another 1%. And again, when we look at the potential gains, if we're right, we could be wrong, but ultimately that's why we diversify. But I think there's a better than 50% chance that we're right. compounded growth rates are really hitting our targets, and that's really what we're focused on. So again, we should be looking at 212. So we should be looking at 2.12, where we're currently investing in it, adding more. 7 is what our target would be. And for 4 years into the future from here, we're looking at a growth rate of 34.8% compounded. So they're the decisions that we're making with regards to allocating capital from here. So that's what we added to the portfolio. These are potential additions. I don't want to rush into it because I want to make sure that we're maximizing our returns over the next couple of years from here with the 10% of available capital. One company is 3M. Now, 3M has a lot of challenges, but you're not going to buy a business that's perfect. I remember we used to own ExxonMobil, and everyone said ExxonMobil is a terrible company to own because they're borrowing money. They're borrowing money in order to pay their dividend. But if you understand resources, you want to buy them when they look like trash. You want to sell them when they look beautiful because it's very cyclical. So there's a couple of questions here before we get into 3M, actually. What if you have several? Okay, so one second. There's a couple of questions here. Rushil, what's my take on adding to Amazon at these levels, and when will they see return on invested capital improve from their capital expenditures? Guys, I'm just going to be 1 second. I don't know if you guys can hear my dog, but he's at the door here barking. I think he wants to be fed. I'll be 1 second. I'll just be 1 moment. Okay, sorry about that, guys. The dogs are worse than the kids. Very demanding. So about Amazon, yes. So I'll go back to Q4 2017. In Q4 2017, Jeff Bezos was he was told that, or he was congratulated on a fabulous quarter about how great his earnings were, and you can see it in the earnings. It was like a 50% or 60% growth on the bottom line, and all the analysts were like, wow, great job. I think it was Q4. So you can see it right here in the numbers. You can go and listen to it if you want. Q4, so here it is here. Like when you look at, this is Amazon. You can see huge growth in terms of, let me see, where is it? It was one of these anyway. Huge growth in terms of margin, profitability. You can see the big massive jump here from 300 million up to 1.8 billion, 250. Anyway, massive jump in Q4 2017. And he got a round of applause from analysts, or he got a round of applause from analysts for such a great quarter. And what he said is really, really important. He said, we earned this money 3 years ago when we started investing for this quarter. He's like, our capital pays off 3 years into the future. And that's like when people are saying, oh yeah, just buy Apple. Like, where's the innovation coming with Apple? All they're doing is raising prices and buying back stock. That's it. And there's nothing wrong with that, but they don't have a vision. And Microsoft, what are they doing? Well, they're optimizing M&A, like buying gaming companies. What is Google doing? I really don't know. But all of the other companies don't seem to have a long-term vision. Amazon and Facebook seem to be the only two of the FAANG companies that actually have a place to put all this capital. And it's really easy to understand where that capital is going. Like 45% of the capital expenditures. This is not Amazon. These are not Amazon's numbers. 14 billion, I wish, but it's not Amazon's numbers. Amazon's numbers are like 60 billion. Yeah, there it is. So Amazon, you can see like big, massive capital expenditures. So 45% of the capital expenditure is AWS. AWS is really concentrated in the US. So that capital expenditure is reinvesting into different markets around Europe. The reason why that's important is you've got two different types of capital expenditure. So let's say I own a bakery and this van here delivers the bread every morning. So I buy this van to deliver bread, right? And after 10 years, the van breaks down. I need to buy a new van. So I spent $10,000 buying this van, probably more, but anyway, $10,000 buying this van. And then after 10 years, it breaks down and I have to buy a new one. So I buy a new van. How much more bread is this new van going to haul around. 0% extra bread. This is what's known as maintenance capital expenditure. Maintenance capital expenditure. This is what Warren Buffett calls a real expense. Let's say I've got all of these servers, right? So let's say I've got all of these servers. I don't know really what a server looks like. It's probably like, I don't know, a big shelf of all of these computers or whatever. Let's say I've got these servers and they've got a shelf life of 5 years. And so when we're looking at the operating margins at 30%, well, it's 26. It depends on the investment cycle and the contracts, but let's say 30% margin lasts 5 years. Well, the profitability is going to far outweigh its capital investment, right? So that's 150% in terms of profits before this goes down the toilet. So 50% of its cost is going to be generated. So this is growth capital expenditure. And here's the thing: we still have some of the original servers from back in the 90s, right? So they just continue to extend the shelf life. Well, that could be the same with Amazon. We don't know yet. But the servers for AWS, as of right now, the longest maturities are with Amazon's AWS, 5 years. As of right now, I think you only have 2 years with Microsoft Azure and Google Firebase. But these servers can last a lot longer and those margins can be a lot higher. But anyway, as of right now, what does it tell you? As long as the demand's there for every server that's built out, it'll generate growth into the future. So that's part of it. That capital expenditure will generate growth into the future. 45% is being invested into AWS, pushing it internationally. Most of their servers are in the United States. The second part of it is advertising. Advertising is the same size in terms of profitability as AWS. Now, advertising doesn't exist without 1P. It doesn't exist without 3P. It doesn't exist without Prime. It doesn't exist without all of these other auxiliary businesses. So it's very profitable, but it's not a fair way to look at it. It's very profitable because of the rest of the business. So when people are doing a sum of the parts valuation of Amazon, it makes no sense whatsoever because parts of the business only work because of other parts of the business. Advertising is one of those. But here's the thing about advertising: generating the same dollars as AWS, but it doesn't exist internationally. So some of those capital expenditure goes into maybe reinvestment into international markets. They don't disclose what their capital expenditure breakdown is, but they did mention it 2 quarters ago on an annual report that 45% went into AWS. But they did also tell us like where markets have an awful lot of growth. So advertising is really only in the United States. There's a whole world out there for growth. So some of the capital expenditure could be in there. Some of it could be AWS. We know it's 45%. We know the economics of AWS. We know it will be profitable and we know it would generate a strong return. So it would be growth CapEx. So listening to what Jeff Bezos said in 2017, like we sowed this quarter up 3 years ago in 2014. And that's why we were so profitable this quarter from the investments we made 3 years ago. Well, the investments they're making today will pay off in the next couple of years. And today it's hilarious to hear people talk trash about Amazon because they barely pull back. They barely peel off the first layer of the onion. The reason why the price to earnings of this company is very high is because they actually have a bloody vision and they have somewhere to put that capital. So comparing price to earnings of Amazon to something like Apple is just completely pointless because Apple are just buying back their stock. They have nowhere else. They don't know what else to do with it. Whereas Amazon have tons of places to put it. And considering 19 times when you consider the enterprise value to EBITDA at 19.68 times, it's a fair reflection of what the valuation of the business is. It's not as expensive on the outset, but if you understand the business, where the capital is going and the returns on that, yes, it's a great business. So I'm rambling on here, but would I invest more in Amazon? I have been thinking about it. So I have obviously done one of these for Amazon as well. Give me 1 second. It's here somewhere. Amazon. There it is there. Amazon. It is undervalued. I think it's coming in at about $170 potential upside. But here's the thing. Analysts get very pessimistic, or they're very pessimistic on Amazon at the moment. And we could see some tailwinds, upgrades. I've also looked at the enterprise value to EBITDA at 30 times. Historically, it's been 38 times. So how I get that multiple, I try and consider what the market's willing to pay on average over the past 15 years. And that's what I use there. And the market's paid on average 38 times. And it's very cyclical. It's not a case where like PE goes from 1,000 down to 20. Enterprise value to EBITDA is quite cyclical. It's adding back non-cash expenses. So it's not like a PE going from like 1,000 down and the average is like 30, but the fair is probably like 10. It's not like that. So we would have 30 times, which is below what the average has been for the market. At $89, I'm getting a fair value in and around 178 for this, which is 100% upside. So yes, again, going back to what I mentioned, I'm revising over all the current holdings within the portfolio to consider whether I should add more capital to what I currently have and what the expected return would be over the next couple of years if I was to invest it somewhere else. So yeah, I am considering it. Absolutely. Jaden, I'd like to know your thoughts on what sectors could be hardest hit and what could be the best performing next year. Well, this is one of the reasons why I built this out, to be honest. I wanted to see, it's not completely finished, but I broke down the S&P 500, every company for the S&P 500, and I broke down, obviously, its growth rates. Its price earnings is, don't ignore that, it's a little bit off. I actually used the cash tag here and I dragged it down. So it's all measured against D3. So all of those PEs are wrong. I got to fix that. But I calculated the growth rates for each different industry sector, looked at the weighted average cost of capital in order to understand the value creation, taking the return on invested capital away from the cost of the capital, looking at the intrinsic value, its discount for every sector. Now, this sheet is massive. It's kind of slow, unfortunately. Let me just see. And sometimes outside of market hours, it doesn't load. Let's see. Yes, some of them are working. But anyway, what I wanted to show you is in red, it's a premium to its fair value. So all of these in red, they're sort of overvalued. And what I wanted to do is try and understand which sectors are clustering undervalued versus overvalued. And what's interesting is the sectors that are undervalued, consumer discretionary, right? Because they got beaten down this year massively. We have some consumer discretionary like Overstock could be in that category, absolutely crushed. These are all trading at massive discounts. So I wanted to see which sectors were way undervalued and which sectors were way overvalued. So what was overvalued was staples. What was also overvalued was, so this is financials. Financials have got a lot of cheap companies. Now, financials breaks down into everything from insurance, REITs, what you call regional banks, stuff like that. But the vast majority of these are trading at a discount. A lot of these here in industrial products. So we look at Deere & Co. We look at CAT, which is here. These are a little bit overvalued. A competitor to there is the Taro company. So again, got a little bit overvalued. There's a lot of other companies that are undervalued that I decided to invest in. But you can see that this is all sort of not really in and around, like it's a little bit of no man's land. Basically, what I'm trying to say is there's a number of sectors that cluster: medical, financials, utilities, but I'd be very careful with utilities. Utilities are all of them are saying deep discount, but the problem with a utility is it's all coming from the changes in working capital, which I don't really trust my estimates in, so I probably wouldn't make an investment there. But what I'm trying to say is all of the interest rate sensitive assets are actually looking really interesting. Financials, including REITs, etc., consumer discretionary, medical specialities, industries that have been really hit by interest rates all look deeply undervalued. If the interest rates are going to continue rolling over, like what we've seen, like you look at the 10-year, 10 years down quite a bit, actually. It's gone from 4.3% down to 3.5%. It's quite a decent amount down, actually. If that continues to roll over, even just slowly, it's going to ease up those industries and sectors. Demand will reset. So those sectors might be really interesting trading at a deep discount. But I don't know. Markets are usually cyclical and they usually move with flows. So if we do start to see an easing of liquidity, regardless of what happens to the economy, those sectors should start to ease up, in my view. So I hope that helps anyway. Medical is screening out. Financials is screening out. Financials is not just banks. It's also REITs, insurance companies, etc. We also have discretionary, stuff like that. Sam, what are my thoughts on building smaller portfolios and diversification? Should they stay the same or be more concentrated? What about building? Look, at the end of the day, I think what you're trying to ask me is, if you had a smaller dollar amount in your portfolio, should you be more concentrated? And that's a complete fallacy that somebody made up that hasn't got a clue what they're talking about. And the reason why I say that is risk at the end of the day, and return is return. If I invested in the S&P 500, I would have made 10.1% on average. You can be right for 5, 7, 10, 15 years with a concentrated portfolio, but the chances of you lasting forever is going to be a lot lower. And we've seen that from time to time. Like I'll show you this post that I mentioned last. I mentioned this on Twitter a while ago, but his name is Crispin O'Day. No. Let me just find this post here. There it is there. Let me drag that in. So I posted this last year on March 2nd, 2021, judging by Chris O'Day's track record, specifically 2002 to 2008, I bet O'Day outperforms over the coming years. Might be worth checking out his thoughts. The reason why I said that is there's different macro environments. Low interest rate environments, tech, long duration does very well. We've seen that in the 1990s. Higher interest rates, higher inflation, short duration assets do very well, more value orientated. And the problem is investors, a lot of people can't swap between the two. It's very difficult for people to swap between the two. And so they're very good in the 90s, they're terrible in the 2000s, they're very good in the 2010s, they're terrible in the 2020s, and so on as we go through these different market environments. Well, I've noticed that a lot of people's performances, like Crispin O'Day's, look like this, where Crispin O'Day didn't make a dime from 2010 into 2020, 2021. He didn't make a dime. Look at his performance. He still massively outperformed this linear chart here. So he's really good in this market environment, and he's terrible in this market environment. The average of the sector has been linear, but it's still massively underperformed. Guess what? In 2022, you know what Crispin O'Day's performance was? 150%. Now, the guy is a bit of a gambler, but the point being is we're moving into an environment with higher inflation, higher interest rates, and it's his wheelhouse. He's doing very well, but he went a whole decade of losing money. Not losing money, but losing money in real terms, yeah. When you factor in inflation, he didn't make anything. You factor in fees, his clients lost money, but it was all made up inside 1 year because this is the market environment that he understands. So what I'm trying to say is, going back to that comment about concentration, I think it's a really, 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 really silly sort of thought process. What matters is making money in sort of all markets and doing well long term. If you're concentrated and you make the wrong decision, you're wiped out. And you see him with Cliff Sosin, over $2 billion. The guy was around since, I think his fund set up in 2012. Perfect timing. Set up in 2012. He's been around for 10. This is his 11th year. His business is gone. It's gone down the toilet. Down 75, 80% on the year. Lost all his clients' money. Nobody's going to invest with him for quite some time. He has to rebrand himself. Now, you don't have that luxury. He's been collecting fees for the past 10, 11 years. You and I, as we invest, we have to make a return, right? So we can't make that risk. So that's why I constantly, again, champion this idea of diversification. I think it's very important. And you have a lot of people that listen to Warren Buffett saying diversification's for idiots. I focus on one company, Berkshire Hathaway, which owns 48 separate individual businesses that also produces cash flow. And so it's a very different environment. You know, listen to what he says versus what he does. That type of passive advice, like that type of passive understanding of what Buffett's saying is really going to get you in a lot of trouble. So diversification, 25 to 35 positions, in my view, is crucially important. It's really important. And there's no shortage of good quality companies. You seen a moment ago, we looked at 119 companies. All of them had greater than 20% return on invested capital. If that's all you focused on, 26% of them underperformed the market, fine, whatever. 73% outperformed. And some of them, like NVIDIA, massively outperformed, 42% compounded. And it's down. What's NVIDIA down this year? NVDA, it's down, what, 50%? But even with a 50% drawdown, the compounded growth rate, 51%. Even with a 50% drawdown, the compounded growth rate is still very impressive. So diversification, I think, is incredibly important, no matter how big your portfolio is. And sort of that mentality of getting concentrated with a small portfolio, the reason why I think it's a mistake is because a lot of people think they're going to get rich quick by buying a company that's going to double in the next year. And that's not really playing the odds. So that's sort of what my view is, but take it for what it is. Rushil, what if you have several companies from one sector, such as tech? How does that impact diversification on a portfolio? So diversification, you can look at it in many different ways. Traditional diversification means diversification through different asset classes. So you'd have like 25% in maybe foreign exchange, 25% over here in commodities, 25% here in equities, 25% in fixed income. And with the new asset class, you could have maybe a small allocation out of one of these could go into real estate, or a part of it could go into digital assets or whatever. So diversification in its traditional sense means across different sectors, across different asset classes. I don't like that. I don't like investing across different asset classes because the level of analysis is very different, and it's just not it's not my wheelhouse. So it's not something that I like to do. I like to focus on what I think I have some strengths in, and that's really where I like to focus. So with diversification, you can look at it like this. If I buy one company in a sector, right, and there's 20 different companies in this one sector, right? So I buy one, and there's bird flu, and that bird flu, let's say it's chicken farmers, like go back a couple of years ago, Pilgrim's Pride. Pilgrim had bird flu, and they had 6 million chickens that they had to euthanize back in 2013 or 16 or something like that. I can't remember, but it was a few years ago. So they had a number of chickens that they had to euthanize because of bird flu. Now, if I only own one company in that sector, I'm screwed, because the one exogenous risk factor to birds is the company that I own. So if I had 3 companies in the sector, would it matter? Not really. I've diversified that risk, right? That's company specific risk. And I've diversified that away by owning 3 as opposed to just 1. So that's one way in which you can diversify. The other way in which you can diversify is sector risk, right? So you would have one company in this sector, 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 and so on. The way in which I approach it, and I'm not saying it's the best way, but it's just the one that makes most sense to me. I like to look for a good quality company based on a number of different metrics. Before, I never really looked for catalysts, but now I'm kind of considering that maybe that's something I should do. Before, I'd look at price, value, long-term growth, and I'd just buy it. So going back to that example with Arista Networks, I mean, for a year, it didn't do anything. I got bored, and I should have just stayed patient, and I didn't. And I lost out there. But before, like, I could have been looking, for argument's sake, for a catalyst or something like that that could actually start driving momentum in the share price. And that might be maybe interest rates coming down or whatever it may be. It might be something. But historically, I've always just looked at the value I get versus the potential growth. And I know I've just sat through volatility, but the diversification within the portfolio would mean that the volatility was lower. So the way I look at it is, within this big basket of a portfolio, if there is the maximum that I like is 30% in one sector. I don't like more than 30% in one sector, but I could have 30%, let's say, in one individual sector, and I'm okay with that. And if we go over to the eToro portfolio right now, we can see that the largest sector, well, there's 3 different sectors: producing manufacturers, retail, trade, technology, all have 14. So I don't really have those concerns at all as of right now. There's plenty of diversification, but there's some circumstances there might be a case where the valuation or the concentration of the portfolio sort of changes. That's a possibility, yeah. But I don't like to have it more than 30%. So that's just the way I do it. I'm not saying it's the right way. Why did I put the allocation of available funds on hold? Do you expect that the next week the market will fall in anticipation of CPI? I wish I was that smart, but that's not the reason. The reason is, right now, there's a lot of companies that are deeply discounted. And I think there's a hell of a lot of value out there, and it's really about turning over rocks. So that's why I started this sheet. I wanted to see all of the different companies that are out there that have good quality metrics. They're solid businesses. They've got some sort of competitive advantages. And I wanted to work back and see which one can give us the best bang for buck. It's been a very long time since I had 10% cash. So the reason for waiting is I just don't want to rush it. There's a lot of value out there. Like, you look at the Taro company, this one ran pretty aggressively. We bought it at 80. It kind of didn't do anything for a number of months, and then it kind of ran pretty aggressively. 3M is really only starting to come out of the woodwork as of right now. And I was looking at 3M and I was like, well, what else is out there? 3M has an intrinsic value of 148. So if this got down somewhere closer to 117, and by the way, markets, even though the intrinsic value is 170 or 148, it doesn't mean that that's the upside value. It means that that's the fair value relative to its cash flows. But right now it's trading at a discount. We know that markets don't price efficiently. So value goes undervalued to overvalued to undervalued. So this is just like a guide. I read the Warren Buffett Way recently for the first time, and Buffett looks for 25% discount to intrinsic value. So I started to screen those out. That's what I'm looking for. So that's essentially why I'm waiting is I just want to see what the best opportunities are. 3M is very interesting where if you go through their latest conference call, so obviously there's issues with the earplugs from 2018, and I can start with that because this is where the opportunity presents itself. When the market thinks something's going to happen, you're dealing with 60% of the information and you're right. And if that plays out that way, well, then you make a lot of money. But if you're wrong, you're going to lose some. But if the market's mispriced, you can make a lot of money. So if we go down here to retained earnings, these are earnings that are retained by the business. 2018, they had 40 billion. Trailing 12 months, they have 48 billion. It's not 45. That's 2021, but they have 48 billion. So they've increased their retained earnings by $8 billion since 2018. Why is that important? Well, the largest payouts, settlements, were $148 billion to the tobacco industry as a whole, which amortized over 25 years. So that was the largest, but it wasn't to an individual company. The second largest was to Volkswagen, 14 billion. And that was again over a number of years, in excess of a decade. They could pay that slowly. And then after that, it gets down to like $1 billion or whatever. So if you look historically at settlements, it's nowhere near, like some people are suggesting it's 100 billion. Historically, it's unlikely we're ever going to see 148 billion again. That happened in the 1990s. It was an industry-wide scandal, and the tobacco companies all got screwed. Every single one of them, not just one individual company. We've never seen anything like that again. The closest thing was the Dieselgate scandal with Volkswagen and the emissions. And then after that, all of the settlements are like $1 billion. So if you look at it and you're like, okay, the higher end, $8 billion, well, that just brings us back to retained earnings back in 2018. So I think there's plenty of cash there for a settlement. These numbers that are turning around 100 billion is just pure fear in my view. When you look at the metrics of the business, it's as profitable as we would want it to be, right? So it's incredibly profitable long term. There are cyclicalities where it gets down a little bit with higher inflation and whatnot, but it remains above 20%. The higher the return on invested capital, the better. So this is showing that obviously the business has a high return on equity, high return on invested capital, very profitable business. Its balance sheet is quite stable. It's got a lot of retained earnings to solve a payout. If there's some sort of settlement, they'll be perfectly fine. And most of the negativity is already priced in. If you look at it on a price to earnings basis long term, if you look at it on a price to earnings basis over the long term, we're trading like pretty close to its lows. We're coming off its 10.41 times. It's pretty close to its 15-year low. It's going back to 2007. It's pretty close to its 15-year low in terms of price to earnings. If we have a look at enterprise value to EBITDA and factor in debt, cash, and depreciation and amortization, we're at 9, which is below its average of 1071. So the valuations near term are below its fair value. You look at its intrinsic value, looking at DCF, somewhere around 148. You look at some of the challenges with the business, intrinsic settlement is a problem. And then you listen to management. So going back to what I mentioned about looking at a potential catalyst, look at the latest earnings report. I thought that this was really interesting. You go down to the Q&A and you listen to what the management was saying here. Next question, Goldman Sachs. So he was asked a couple of questions about earnings, margin expansion. So they're looking at obviously expanding margins through cost cutting, more efficiencies with their inventory. And they were talking about a headwind with the US dollar. So if the dollar rolls over, which it has been and it continues to roll over, it acts as a tailwind because a lot of their revenue is international. And they're talking about their margins expanding because of cost cutting and more efficiencies related to inventory. He was asked a number of times about, look, are margins moving forward going to get better or worse? And he's like, they're going to be positive. Like, what's your outlook on that? It's going to be positive. He's like, he thinks the margins bottomed in spite of inflationary pressures, he thinks that we're pretty close to the bottom in terms of margins. So we're at an inflection point. This is what I was talking about a potential catalyst. Of course, I use technical analysis as well. I use Elliott Wave, and this has been going through a bear market since 2018. So this is when the litigation started, possibly closer to a settlement. But we're buying it at a deep discount if we buy it. We're buying it at a deep discount. Very profitable business, inflection in margins and profitability. So this profitability will increase again, the return on invested capital. If margins expand, the dollar coming down is going to be a tailwind to their business as well. All of this is happening, and it's trading at a discount. So somewhere in and around 117, I might buy it. And so just looking at this relative to the Taro company, okay, I've sold the Taro company, but there could be other companies like 3M or even better, like where Warner Bros is today, that could offer up better returns over the medium to long term. And that's why I'm kind of stalling the ball a little bit, trying to figure out where the highest expected return would be. You look at something like Pool Corporation. Pool Corporation has an intrinsic value of 417. I love this business, incredibly profitable. If it goes lower, I'll add some more, but longer term, this is a massive winner because of the dynamics of the industry. The industry is not going to go anywhere. Swim pools, like you go back to global financial crisis, and this is really important about these type of industries. I'm trying to find Pool Corporation at a discount. That's what I'm trying to do, at a massive discount with that 10%. That's what I want to do. You look at Pool Corporation, yes, it has some sort of sensitivity to the housing market, but not as much as what people think. Let's have a look at gross margins in the global financial crisis. What happened to gross margins? They bloody went up. They went up in 2008, 2009. Why? They liquidated inventory. They didn't rebuild their inventory, and demand remained pretty robust. At the margin, new builds went down. That's only 20% of their business. It's a very durable business, very profitable. And even in a global financial crisis that was driven by real estate, and households, their business was still robust. We're not there today. So if I get any chance to buy this at a discount, I'll buy this and I'll hold it forever. Well, depending on if someone wants to pay me a lot more for it. So just to your question, like, why am I holding a lot of cash and why have I not allocated it? Look, this year's been pretty brutal. We need to make the next 3 years count. And I want to make sure that it's well positioned. Keep the head down, get the right opportunities, just focus and let the numbers speak for themselves over time. That's all we got. That's really where I'm focused. So Tom, do I have a link to the director's comments? I was quite upset they didn't say something like that during the interim call. It was, you could probably find it. No, IDS. So they changed their name. GLS spinoff is greater threat to Royal Mail than job losses. Okay, so this is probably after the director's comments. It was in the Times that if GLS spun off, Royal Mail's fucked, pretty much. Maybe it says it in here. It'll have a link. I'm not sure. You'll find, just search it. You'll find it. Change of holding company net. Yeah. And I think part of it was to let part of changing the name, the unions were mingling the entire business together saying, hey, listen, we know you're very profitable. And Royal Mail were like, yeah, but Royal Mail, where you're trying to squeeze us, is pretty shit business right now. I think part of the reason they changed the name is because they kept commingling funds. If you want to pull out that word, that's essentially what was happening. IDS repeats warning that business could be split in two. So this is, yeah, there's a lot. You'll find it. They said it in a number of different interviews. You'll find there's lots of articles out there. You'll find it. So that was director's comments. Tom, is there a process the tracker funds follow to accumulate the shares, or do they go through the open market? I don't know. I'd love to tell you that I know. I'm not sure, but these will probably I think they have I don't know. I just know that they have to allocate, all the tracker funds will have to allocate it. Geez, they're adding Rivian. Man, that is a big mistake. Why would you add Rivian? Anyway. I don't know. I don't know the answer to that, Tom. I just know that it'll be allocated, and over my time horizon, it's not something that I'm really too focused on because I think it's still undervalued. Any past examples of stocks being added to the index? I mean, Tesla more recently was added. CORM a couple of years ago had a bump when it was added to the Dow Jones, but obviously it's down a lot because sort of the macro and liquidity environment. And I'm not sure how their business is doing, but that was added not that long ago. Rob, do you think Overstock can return to pandemic levels of profitability within the next couple of years? So with Overstock, Overstock has a couple of different opportunities built into it. Obviously, there's the residual value of its cash, which if they don't do something with it, the market will mark it down to zero. So there's the cash component of it, the lack of debt. There's a Medici Ventures component, and then there's the e-commerce business. And the e-commerce business, the reason why I like it and the reason why I really like it is there's a very little risk of default for this company or any sort of financial issues. And the reason being is they don't hold any inventory. So they get 3% to 5% operating margins. It doesn't seem like a lot, but they hold no inventory. And it's just based on the volume that's done over their exchange. Not over their exchange, over their website. So that's what it's based on. As they enter new markets like Canada, that wasn't in during this period. They weren't in Canada. As they enter as of right now, they're a value brand. They compete with what do you call them? It's one of the biggest value. IKEA. They compete in like that IKEA category. As they move into more luxury, competing with Wayfair, etc., that's a new category that wasn't there, and they have the cash to invest, and that's what they're doing. They're marketing as of right now. You'll see an awful lot of their advertisements. You can probably go on to YouTube and see their advertisements. But as they move into these new markets, it increases the possibility of them selling more products, and it's really just about the volume. So what impacted their furniture business this year was higher interest rates, slowdown in the real estate market, and ultimately two of those are kind of joined at the hip. So as of right now, you see mortgage rates slowing down. If we see a slight easing up of the real estate market, it's going to directly impact them. But also at the margin, from an operating perspective, they're opening new doors to increase their operating margin. So to answer your question, when you understand that the business is just taking a percentage to connect a customer with a seller and they hold no inventory or anything like that, it's really just about volumes. And then when you break down the market environment, yeah, absolutely, I think they can exceed that personally. But we will soon find out. Analysts don't seem to think so, but I think when Bed Bath & Beyond restructure, it'll probably be a smaller business. I think when you start to see Wayfair restructure, it'll be a smaller business. By restructure, I mean bankruptcy. These companies don't have enough cash to see through the next market environment. But as these start to restructure, you get smaller businesses, and an awful lot of that demand, I think, will find its way into Overstock. So yeah, I do think that's a possibility. David Goon has been very quiet over T0 since he took over a year ago. Do you still? Well, I mean, just because he's quiet doesn't mean anything. Name another private market CEO that bothers to come out to the public. I mean, it's a private market business. Yes, a public company owns it, but he's not at liberty to come out and give us an update. So if he does, I mean, great. But we can see through partnerships and media via like ICE markets, etc. We can get some updates that way. But yeah, I'm not too concerned about him being quiet. There's a lot of work that needs to be done over there. I'd rather that he was quiet and building than loud. And like you look at people like Beyond Meat had a huge opportunity, but the CEO Ethan Brown he's just a complete salesman. He constantly promising the world. Again, when you're looking at valuations, everything's about forward expected earnings. That's what drives the share price. I used to have a position in this. Unfortunately, I got out and made a little bit of money, but the forward earnings were expected to be 60% based on what the management were guiding towards food services, like in restaurant deals with restaurant brands, deals with McDonald's, all this sort of stuff. And every single quarter, oh yeah, we have that deal, but it hasn't really materialized yet. And then we started to see the downgrades in earnings. But this is a CEO that spoke way too much and acted way too little. and his company now is it's going to go to zero. They don't have enough cash to see it through. So this is another restructuring case where the equity is a zero. But this is a CEO that, you know, analysts were asking questions about the business and the performance. They're coming up with estimates. And what you quickly realize is most of what the CEO is saying is just total nonsense. Like he's just talking through his backside. So just because the CEO is very loud, it's not always a good thing. And that's an example of how you need to be careful there. RAS, NEX seems dirt cheap, plus oil prices improving, but the price is further strangled. Plus, I guess, far-fetched. Is that a company beaten down massively? Yeah, I owned, that was part of our portfolio. We had a small position in National Express after 2020. In and around here, we had a position and it sort of went up massively, so we got out of it. It was only a small position. I think we could probably look at, let me just pop this. Let's have a look. We can probably do a quick rundown of what the expectations are in a DCF. We can do this real quickly. Yeah, so it's still not at a profitability point, but we might be able to spot that in a second. It's had huge problems. Again, if there's an inflection here, it might be interesting, but its margins got crushed, probably due to high energy costs. They've got like buses and trains and whatnot, and certainly with energy prices. I mean, they've got trains over in Germany and the UK, and electricity prices were brutal in both of those regions. So yeah, it's impacted them massively, but energy prices have come down a lot. Okay, let's have a look at it. Let me go to estimates. Let me just see, do we have enough 2026? Okay, I'm going to put this over here so you can see it. I've got a wide screen, so that's why I'm just dumping it to one side for a second so I can see it. All right, let's just copy and paste. Once this loads, let's just copy this and let's paste it in here. I haven't looked at this in a long time. So LONNEX should come up anyway. While it's coming up, I'll input the data here. So we have I'm not going to be doing loads of these. I've got a feeling that everyone's now going to ask me to look at a specific company. I'm only just doing this one. I learned my lesson the last time about talking about stocks on the internet, and I'm not doing it again. Okay, so the tax rate of the company is expected to be what? 26%. What is the end of year? 31, so that needs to go back. And there's 31 days of the year. So we need to change this here as well. That needs to be 12/31. And we just make sure, because what we're doing here is we're figuring out how much of these cash flows, 0.06, we need to factor into our valuation. That's what we're doing here. Okay, so next we need to get the depreciation, amortization, D&A. Where are you? There you are there. So 241. Capital expenditures next. 260, 610. Interest expense is what? 56 million next year. Wow, it's gone up. $56 watt. Where is it? So this is pulling. It's pulling it in pence. So 1.53. Just change it. Okay, let's pop on over and get the debt levels. Let's see what the multiple is. Enterprise value to EBITDA. Average is about 8.2. Let's have a look at its debt levels, financials. Short-term borrowing, 0. Current portion of long-term debt. Long-term debt. Cash. So we changed the earnings. The tax rate's 26. We don't know what the discount rate is. What are we missing? Beta. So we'll get it here. So National Express statistics 1.31. There it is there. So we changed it to 1.31 because it's not pulling the data properly. So you've got a discount rate of 6.42. I would say the growth rate probably, I don't know, like 1% maybe. It's going to be a little bit slower. Share price, outstanding shares, okay. Taxes, changes in net working capital. Okay, I need to go to cash flow. What has it been historically? About negative 20 million on average. Year in, year out, they're negative. So you got showing a deep discount here. Am I missing anything? The multiple I changed, the tax rate I changed, the debt and cash is there, outstanding shares. So, okay, so this is, yeah, I mean, yeah, maybe you're right. Maybe this is deep. I wouldn't trust that IRR. Ah, God damn it. Yeah, that needs to change. That needs to be the same as this here. Control C. Paste special values only. Yeah, 31%. Changes things a little bit. Okay, so we have the perpetual growth, looking at terminal value using perpetual growth. It's pretty close to enterprise value to EBITDA. Average is about 4.1 billion. Yeah, I mean, $5 it's coming up at, but I mean, there are some risks with the business that you need to consider. And those risks could be energy, for argument's sake, stuff like that. But it's coming up at £5. Alt H. That's sort of where the intrinsic value is sort of lying. I don't know. I don't know what to think about it. I haven't looked at it in a while, but it's maybe a little bit of peace of mind there. It could be an opportunity, yeah. You're very welcome. Could you share the thesis on Celanese? Yeah, so Celanese in the chemical space. Dow Chemicals is another one that I'm very much interested in. This space is just absolutely dirt cheap across any metric you want to look at. And the reason why that's important is, let me throw this back on over here. The reason why that's important is, you know, if earnings do need to be revised lower, you've already got a lot of that priced in with a much lower multiple. So you take Celanese as an example, no matter what metric you want to look at, this is dirt cheap. It's coming off its lowest point. It was down as low as 586, and that's factoring in the global financial crisis. So look at the last 10 years, you know, even in around 9 times, and the reason why it's 9 times is a little bit of a downgrade recently, but over the medium to long term, there's plenty of opportunity for huge amount of upside. If we have a look at this relative to gap earnings, I think it's trading at about 8.7 times 2023's gap earnings. Look at 12.57 in gap. Yeah, so if we take the current price, 102.36 divided by 12.57, 8.14 times at current prices relative to gap earnings. So on a valuation perspective, first and foremost, it's trading at a big discount. And then it comes down to the business opportunity. So the company raised a lot of debt. If you have a look at its financials, it's a little bit quirky, right? So if you go over here, you can see debt issued 9.2 billion. You look at the balance sheet, 9.6 billion in cash. And the debt is not showing up yet as long-term debt. So that cash is debt that was issued to buy M&M from DuPont. And M&M, the reason why they bought it is because it can open up a whole suite of products and sales to a company called Toyota. So they've got an awful lot of products that they could upsell to Toyota. So the synergies was about 450 million. And between the two of them, you're paying a valuation that was slightly below where Celanese's current valuation is. So part of it had to do with the opportunity in that M&A deal, its valuation, and then its market and its CEO. So the CEO is really interesting. She is aggressive. She's really, really, really aggressive. I think it was this earnings call here where she really bashed an awful lot of people. Thanks for joining. Given the macro uncertainty of the world right now, I wanted to take a few moments to set the tone for this call and re-emphasize the priorities we have as a company. As we prepared the earnings material we put out yesterday, I tried to emphasize two long-term qualities of Celanese and its employees. Okay. Basically, is it here? We cannot predict the future right now. We see, where is it? Anyway, maybe it wasn't this one. Maybe it was a different one. But anyway, the CEO was like, look, the macro conditions are difficult. She was asked a question. She's like, it's difficult, but they've always been difficult. And we don't care. We're focusing on our business and optimizing for cash flow. So anyway, I think the CEO has got a lot of credibility. And so what they're doing is they're changing their business in order to optimize for free cash flow. So previously, they were a little bit reckless with operations. Let's say there was more demand over in Asia. Well, they'd just ramp up production in Asia. If there was more demand over in Europe, well, they'd just ramp up production in Europe to service that. I mean, you might end up with a situation where inventory over in Asia was growing and maybe it was contracting over in Europe. And then ultimately on the balance sheet, you're looking at inventories grow, where what they could have done was just taken inventory from Asia, sent it over to Europe to service demand instead of overproducing, cut back on costs and be a much leaner business and focus on free cash flow. And that's what they changed their business model for, is to really focus on optimizing for free cash flows and changing the structure of their operations to expand their margins. So that's one part of it. The second part of it is they literally sell to every single important industry in the world. They sell specific chemicals that go into paint that goes into painting a specific car. They've got polymers like stuff like brake pads and what do you call them, mud flaps. And like, if you think of the products that they're selling, it goes into like artificial foods, sweeteners, all that sort of stuff. They have all of these different products that are the same thing that are going into a whole host of different, they're raw materials that go into a whole host of different consumer products that aren't going away, which includes like food coloring, flavoring, polymers for all the different plastic components on a car, specific chemicals that go into paint. And so the industry itself is very durable. And with the changes to their business, this is what I recognize. If you pop on over here to, we were talking earlier about what drives valuation. Well, profitability does. Last year, they had 20%. I would ignore trailing 12 months. That changed on the latest quarter simply because the M&M deal went through. So debt increased massively without factoring in all of the earnings of M&M yet and its synergies. So just ignore that just there for a moment and focus on what the business was doing a year ago. It increased to 22% with the changing focus. So the company moving forward with its new fundamental approach towards operations is more profitable, or at least we have, at least in 2021, we have at least one data point that suggests that's the case. Obviously, they increased their debt massively. So when you're looking at return on invested capital, the invested capital increases massively, but we haven't seen the return increase yet. So they just closed the deal. So that might change moving forward. So I had a little bit of evidence that their plan was working out. The CEO is laser focused on cash flow and optimizing for cash flow. The business is cheap. It can actually, like, here's the thing. If we pop on over here real quickly and we go to ISM manufacturing, I currently only have 3% invested. That's another one where it's deeply undervalued again when we're looking at intrinsic value. And again, like, these kind of cash flow models are not the be all and end all, but it's a good sort of ballpark to think about, you know, what could be possible. This is deeply undervalued. It's coming in at $268, about 162% on the upside based on this coupon of cash flows. Currently only have 3%, but there's a possibility of a little bit more near-term weakness where I'll buy more. So let's look at the PMI manufacturing, the latest manufacturing. So it dips its toe into contraction for the first time. But more importantly, if we have a look at chemicals here, let's zoom in so you guys can see it. Chemicals, the commentary from purchasing managers in chemicals, future volumes are on a downward trend for the next 60 days. So markets, like there is a look-through element to markets, but if this catches the market by surprise, it could be the case where there might be some near-term weakness. And I think that there is a possibility. Like, I mean, I'm charting it out, and if we got down to $78, I'd like to double the position. It's a longer-term position, but that's essentially, from a high-level perspective, it's a combination of valuation, deep discount to intrinsic value, improving profitability based on its operating efficiencies, and I think they have the right CEO to sort of drive it through. And so that's why Celanese is there. Do I think the risk to reward is favorable for Zim? Of course I do. The reason being is if we look at our portfolio, what you'll see is the equity is down in the portfolio, but the thing that we need to factor in is that this is a company that just paid out $2.95 per share in a dividend, which we just received. So if we adjust it, so we paid $23 for Zim, and I'll tell you why I did in just a moment. They're distributing a huge amount of cash back to shareholders. We paid 23, but when you adjust it for the dividend that we just received, it's trading at around like 21.52. So just to give you an idea, the reason why I took the risk on Zim, China reopening, which it will eventually happen. It's not like it's not going to happen. We're 3 years now. Real estate market's crumbling. The social fabric is changing. We're at a point where China needs to start stimulating aggressively or a little bit and reopening. That's where we are as of right now. And so I don't think, because of the leverage in their system, I don't think they'll be able to keep it under wraps for too much longer. And a lot of Chinese analysts are coming out and saying the same thing. If China reopens, it's going to be favorable for day rates. At the very least, it will just stabilize day rates. Day rates don't really need to go up for this company to be worth something, because they have $35 in cash per share. That's per share, right? And so we paid $23 for that. And the latest quarter, the $2.95 that was paid out, that was 35%. That was 30% of net income. So their cash per share actually grew, while their net income, because their 70% of the net income flowed back into earnings, and 30% was distributed back to shareholders, which was 11% of the value of the company. So this is a company that was just far too cheap relative to its cash position. They've reduced most or all of their debt. They put a lot of the cash in the bank into investments, short-term investments, property treasuries, collecting probably somewhere around 4% per year. So the interest income is ballooning as of right now, while their interest expense is actually going down because they're repaying debt, which stabilizes their business over the next couple of years, regardless of what happens with day rates or with shipping rates. So, I mean, it's not really difficult to understand, but it's another one of these companies that has high volatility, and it's going to be very sensitive to sentiment. But cash is cash, and at $35 per share, they just paid 11% dividend, which was only 30% of their net income. And that's $1.1 billion in net income. Their EBITDA, when you factor in the depreciation, was $1.6 billion. Look at the market cap of this business. I want to show, because it's, okay, so we go Zim. Look at the market cap of this business. It's $2.2 billion. They just earned an EBITDA $1.6 billion. So it's a very, 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 very cheap business. And so, look, we've only just taken a position recently. It was 3% of the portfolio. Part of the reason was the massive dividend distributions will give us a margin of safety, but I think that the equity was mispriced, and this could easily trade up to $30 to $50, and we get that dividend as a margin of safety. So if we're right, we make a lot of money, and if we're wrong, we might lose a little bit, and that's sort of the idea there. What does Manish Prabhai say? Heads, I make a lot. Tails, I lose a little bit. That's sort of the idea there. Wouldn't I consider allocating more capital to financials as the yield curve will likely improve? Yeah, so it takes a little bit of time. It takes a little bit of time for that to play out. I have a big position in Citi. It's about 6% of the portfolio. Net interest income is ballooning for these banks. They're over-regulated. So it's not like there's a huge amount of risks with the businesses. There's a lot of deleveraging. There's delinquencies are actually falling over the past 3 quarters. But for some reason, this idea that we're in a 1929 or global financial crisis is permeating, and it's just certainly not playing out. Like Bob here, I follow Bob. He used to be the right-hand man for Ray Dalio over at Bridgewater, really, I love his research anyway, but he shares some really interesting charts. This is what we're seeing right now. The moderation in goods, which we all talk about, is coming off of a very high base. There's trend. We're still way above trend. Services, which we say is we're pivoting to services. The reality is services is still below trend, right? So we can continue to see moderation. The economy is still, it has been booming, but again, with credit slowing down, that's where the challenge is moving forward. Banks will start to relend, but it'll take a couple of months. We've got about 6% invested in Citigroup. We've already received, I think, at least one dividend coupon in cash, which is sitting in the balance, and we're gonna reinvest that. So I think our average cost is what, I don't know, maybe 47, something like that. We've been in it a while, but it'll take a little bit of time. But this is another one that's like, financials are deeply undervalued. Again, I don't know what the catalysts are to drive them higher, probably liquidity, but across the board, I mean, these are this one's, yeah, these are all deeply undervalued. And you, like, my view on, like, just to give you an idea of what my view on Citigroup was. So if you look, this is sort of like how I was looking at the valuation. Let's look at book value, because that's really how you measure financials, is based on its book value, because the difference between assets and liabilities is its book value. And if you think about, the assets are loans, liabilities are deposits, the difference is ultimately the return on that book value. The book value of shareholder equity is really how we really consider banks. So we look at book value, and the average of the other three major players is 1.55x. And we're looking at Citi at, what was it, 0.55x. That's where Citi's trading. It's trading at a deep discount relative to his peers, and that might have been fair, maybe closer to the global financial crisis, because they had a shit management team. They were way over levered, blind. Like, you know that stupid quote about when the music's on, you have to keep dancing? Do you know how dumb that is? And do you know where it came from? It came from the CEO of Citigroup right before the financial crisis, when he was talking about buying all these toxic loans and everything. That's where that came from. So the prior management were higher on their own stupidity. Citigroup, I think it was Citigroup CEO. Yeah, former Citigroup chief said in 2007, referring to the firm's leverage lending practices, when the music stops in terms of liquidity, things will be complicated. But as long as the music is playing, we've got to get up and keep dancing. That's where that stupid quote came from. That's where it came from. So when people start regurgitating this quote, just remember where it came from. It came from the dumbass that used to be the manager of Citigroup, that completely recognized that if liquidity dried up in 2007, they're fucked, but let's just keep on going anyway. That's how stupid it was back then. Excuse my language, but we all got screwed over in 2008 because of these idiots. So that was a prior management. For the past 12 years, this bank has been absolutely pummeled. That CEO's gone. There's a new CEO put in place in the last year or so. It's a female CEO, which everything I've seen is female CEOs are aggressive in terms of operating businesses. But anyway, that aside, with SLR requirements, leverage ratios, all of these banks are pretty much the same in terms of risk, or somewhat the same in terms of risk. There's maybe a little bit more leverage at Citigroup, but I don't think it deserves to be trading at a 1/3 discount to the rest of banks. So part of it has got to do with a repricing of risk. So we could see a triple just to get back up to its fair value in terms of book value, but it doesn't have to get up there, because right now they've got some constraints regarding holding more cash because of these SLR requirements. If we get some SLR relief, which Janet Yellen's certainly been hinting at it. If we get some SLR relief, there's going to be a lot of available cash for what? Buybacks. So this company, between buybacks and dividends, these guys were paying out about 17 billion prior to COVID. That's ultimately what they were paying out prior to COVID. And I think we can get back to that in the not too distant future. So distributions back to shareholders via buybacks and dividends, $17 billion. The market cap's 86 billion today. So I think like we can have a look at it right now. If you have a look at financials and we go to cash flow, it was higher for buybacks. Like repurchase, yeah, there was like 17 billion just in repurchase of stock, not dividends. There was like $23 billion in 2018 in distributions back to shareholders. So $23 billion divided by the $86 billion market cap is a 26.7% of the entire market cap today. That's what they were distributing a few years ago. So where we are as of right now, the repurchase of stock had to slow down because they need to hold more cash. They've got like, I don't know, was it 300 billion in cash? 283 billion in cash. They have to hold more cash for SLR requirements. So if you get SLR relief, we're gonna go back to this period where there's no real investments that these banks can make other than buying back their stock. So if they buy back 10% of their stock every year in tandem with a repricing of risk, it's deeply undervalued. Deeply undervalued. And that's sort of the way in which I was looking at the valuation here is SLR requirements mean that the bank is that the bank itself is sort of like somewhat de-risked. And so the valuation should reset. And I think it's still getting punished for this stupidity that went on back in 2008. These idiots that just literally blew up the entire economy because greed. So yeah, I think banks are interesting. I have Citigroup as a big position. No real catalyst for it to jump, but I do think it's deeply undervalued. Okay, LG, any changes with respect to energy issues in Europe and nuclear? So there's a big fallacy in nuclear. I'm a big bull on uranium, but I've been invested in this since 2016. And I cut half my position in September 2021 when all that froth in the market came about. And the reason being is I think because it's a small market, there's a lot of pump and dumpers in this space. There is a valid case for uranium. You got supply and demand. So supply is contracting and demand is increasing with new dollars going into the market. But you hear an awful lot of stuff like some of the stuff you hear would be the nuclear fuel cycle is 2 years. That's a total lie. The nuclear fuel cycle is 3 to 6 years. So obviously, if you're using a 2-year fuel cycle, you're going to assume we need far more demand for uranium than we actually do. The second thing is when you break down and you go over to like EDF or any of these nuclear operators and you break down the actual uranium percentage of their operating expenses, it's only about 11%. So if the uranium price doubled, it's only an increase of it's an increase of operating expenses by 10%. That's it. It's not this case where utilities are screwed, which again is another fallacy argument. So when you're looking at the market, yes, there is going to be a long-term opportunity here. Demand is increasing and supply is quite tight. It's capital starved. And that's partly got to do with the Soviet Union collapsing and recycling a lot of warheads. But the demand aspect is completely overblown today because it takes 7 to 10 years to build a nuclear power plant. So you're not consuming uranium for 7 to 10 years, right? So then you take a step back and you look at the industry as a whole. Okay, what does the industry need in order to be self-sustaining? Well, it needs $60 to $70, depending on the company, per pound in order to, UX. It needs $60 to $70 per pound in order to be sustainable in terms of free cash flow. We're at 50. So a lot of these companies, like one of the poster childs of easily the biggest rip-off company in the world is a company called Uranium Energy Corp. And the CEO, Amir Adani, and some of his henchmen, there's about 10 of them, they paid himself massive compensation, but the company doesn't do anything. All it does is issue stock year in, year out. 168 million, 168 million, 95 million. What are they doing with that now? Well, they're buying bloody uranium pounds. It's stupid. What the company is doing is they're waiting for prices to go high enough. And while they wait, you see all these expenses? All of these expenses? So the gross profit, literally in the last year, they're literally buying uranium and reselling it. It's just not a really good sort of business as of right now. But If you look at the operating expenses, $12 million for selling and general administrative, this is all staff costs. The company doesn't do anything. So the problem in the market is these companies are just issuing stock to pay their own bloody salaries, and the fundamentals haven't caught up yet. So Cameco is really the only one that's actually reasonable in my view. This has been going on. This scam has been going on for years, issuing more stock to pay operating expenses. That's it. Until the price gets above $60, $70 per pound, I don't think we're rallying for this wave 3. I don't think we're going to see a sustainable rally until we see uranium prices significantly above $60. That's what's going to get us into this big, massive rally. And at that point, yes, it will be part of the portfolio. So either uranium gets cheaper before I put it in the portfolio, Cameco gets cheaper, or we start to see some sort of movement in the uranium price. But it's really important to understand the fundamentals of the sector, because then you can listen to all the bullshit and call bullshit, because there's so many charlatans out there in this specific space. My view hasn't changed. I'm incredibly bullish, but the 24/7 hype just makes me avoid the sector talking about it. So if you haven't heard me talking about it, it doesn't change my view. My view is still the same, just not interested in those type of conversations. That's sort of why I've said nothing about it, but I'm still very bullish. It will possibly be in the portfolio at some point in the future, but for right now, it's just not the right price in my view, or not the right time. What is my fair value in Crocs? $160, recovered very well so far. Yeah, so Crocs is kind of interesting. Let's looking at Lululemon now. Lululemon is a company I follow. I'd never buy it. It was just stupid expensive. And there was no room for sort of downgrade in terms of earnings. And that's what we got. So the share price was down 13% on Friday. Now, Crocs is very cheap. It's very different. It's very different. It's like 9 times earnings, 8 times earnings. But when we look at Lululemon, as an example, what do they give us insight into? Well, margins might be a little bit heavy. Sales might slow down a little bit. So when I'm looking at Lululemon, could that carry over to Crocs? Possibly, maybe. They're very different. Lululemon sell jog pants, but Crocs sell like utility shoes. I call them utility shoes, these foam slipper things. And they also sell like dress shoes that are pretty cheap. But the growth has been pretty impressive, very impressive internally with the company. And here's the thing, it's more profitable, it's higher growth, everything than most of its peers. Nike, not even close. And it's trading at a third of Nike's valuation. So that's what I really like about it. The discounted cash flow model is suggesting it's worth about $160 a share. If I'm right in this, pushing higher here from a technical perspective, so that there would be your wave. I mean, it could exceed like $60 could be just a fair value, right? Over here. 3, 4, and 5. I mean, it could be up around 180. We'll see. I don't know. So this is Citigroup. So let's have a look at Crocs, which is down the end. What's missing? Discount rate. Y. I scraped that information in. Anyway, let's use 4%. That's US 10 years at 3.5%, but let's just use 4. Yeah, 156. So it's the difference between where the current risk-free rate is. But this is coming in with 5% interest, cost of debt's 4%. Yeah, it's coming in at $158 or 156 at a 15x multiple. Even if you put that down to 10 where we currently are, it's still worth about 20% more than what it is, but I think it's undervalued. Its average multiple has been 15, and that's way below like Nike and stuff like that. You know, like Nike is way overvalued in my view. Well, I say that because I'm comparing it relative to Crocs, right? But anyway, maybe there's more longevity in that. Last question, Digital Turbine. As far as I remember, we didn't spend a lot of time talking about this company. With possible recession, will you keep holding? So here's the thing, that industry already kind of went through its, has already kind of gone through its slowdown, and I'll show you why. A lot of physical products that advertise have seen a slowdown since 2021. They're still above trend, but it's slowing down. That industry has been hit pretty hard. This includes like mobile phones. So if we pull up their latest APPS, investor relations, if we pull up their latest earnings, I just want to show you guys something. There is, it's this one here, isn't it? This is massively mispriced, and I think the market sort of started to figure it out. I mean, it doubled in the space of 5 days after its earnings. Everyone was like, here's the crazy thing about this stock, right? So let's have a look at APPS and compare it to the trade desk. They're different businesses, but they actually might be complementary in a way. But let's just have a look at, this is really important. So EBIT for Digital Turbine compared to TTD, the trade desk. Look at this for craziness. This current year, where are we? 2021, 2022. So here it is here. So yeah, this current year. So these guys, the end of fiscal year is March. So this is the end of the year. So for this current year, 2022, the trade desk is going to do 107 million in EBIT, and Digital Turbine is going to do 94. This year is almost over. Why is that crazy? Because the trade desk is 12 times bigger than Digital Turbine. The earnings, like, check this out, year on year, EBIT's actually grown for Digital Turbine. And it's because of the makeup of its business. And I think this is where everyone misunderstands it. It's a very unique, rare business in that they have this network effect. They have connection, and they're embedded with the operating systems. They've got access to the customer via network providers. They are, what else do they have? So every single phone that's ultimately bought has it, that's an Android, has a DT ID, a Digital Turbine ID, and the information that comes over from the network can pair them up with different apps on the phone that are pre-downloaded, and you have a network effect here with the OEMs. So these OEMs that develop apps pay Digital Turbine to find different customers through this data in order to download the app, and then they might get $1 per download. And then you can start cross-selling. So you already understand the customer. So these guys have bypassed Apple, they've bypassed Google, because they went straight to the source. No one's going to recreate this business model again. Nobody's going to be able to recreate this again. And that's the fascinating thing about Digital Turbine is I don't think anyone can, like, yeah, you might get competitors, but I don't think it's ever going to get to the point where, like, how can you be more efficient than this? Even more so when you look at what Apple are doing with data. And so the business itself is really rare, really unique, and in my view, deeply undervalued. And on the latest quarter, we've seen durability in its business. So let's check this out. They done 3 acquisitions. Management worked really hard. They fired a bunch of staff, integrated the 3 businesses together very quickly. And look what happened, right? Look what happened here. Where are we? Total income from operations year on year. It was up 27.5%. Income is up 27.5% while revenue is down 7 or 8% or whatever it is. It's gone from 188 down to 174. Yet the bottom line increased 27%, 27.5% growth on the bottom line. So if we go down here a little bit further here, we'll see where that decline came from. Here, it came from here. The biggest part of their business is pretty much device sales, on-device solutions. So mobile is slowing down massively right now. You can see it obviously in Micron. We own Micron as well. Mobile has slowed down massively. So the number of phones being sold is slowing down. That's cyclical. That will come back. People break their phones all the time. New innovation comes along all the time. There will be more phone sales. Absolutely. This will come back. This is down 16%. 16 bloody percent. Top line down 8%, and they still grow their bottom line 27.5%. That's fascinating to me. The market's like, holy shit, this is trading at $10, reprices to $20 inside 5 days. We correct a little bit lower, some profit taking, whatever. But this is deeply undervalued. I'm surprised it got down to $10. I really am. And I'm not surprised to see how robust the business is. And then when you compare the market cap, so if I go market cap's down here, and if I compare, I wonder if I can do this. I don't know if I can compare TTD, just to give you an idea of just how crazy this is. Can I get? Maybe I can't. Oh, that's a pity. Anyway, this is like, anyway, I don't need to show it this way. You'll still be able to see. This is 1.6 billion. The trade desk, 23 billion. They're doing the same amount of earnings, except one company is more durable than the other. So it's absolutely bizarre. So it's deeply undervalued. I wanted, this is another one I wanted to add more to. Again, look at what's in the portfolio. Where's the opportunities? What price am I going to pay for it? I still think there's a chance that we have this down as a 5 ways. I'm looking somewhere slightly below 15. I'll increase this position. Again, we can look at cash flows now that we know that the cash flows are quite robust, right? They're bloody robust in a pretty difficult macro environment. To grow your bottom line 27.5% while everyone else is contracting is fascinating. It's fascinating to me anyway. Where is APPS? Oh no, maybe it's down the very end. Hope it's here. I might have deleted it. I don't know why I always delete these after I do them. Yeah, I bloody deleted it. It's a pity. It's $41. I won't waste any time there. Anyway, the fair value, I think I've marked it off here. Yeah, I think I've marked it. It's $41 anyway. That's what the intrinsic value is. So it's deeply undervalued, very durable business. Again, it's really easy to look at a high level view and say, trash company, share price is going down, but it's not always the fair. That's the opportunity. That's your alpha. Just unfortunate that a number of them have been hit by this year, but hopefully over the next couple of years, we'll make back plus. So I'm looking forward to it. So Digital Turbine, that's why we bought it. Will I be holding it? Yeah, absolutely. In fact, I'll probably be increasing my position because I think mobile will come back at some point next year. Like Micron were saying, possibly a bottom in Q1 23, and it builds out into the end of the year in terms of growth for mobile. So that's going to be a tailwind to Digital Turbine. So I like it. I like it a lot. Thanks very much for availability and patience. Very good teaching. Really appreciate it, Raz. Really appreciate it. You're very welcome, LG. Okay, so we got to the end of comments. I think I've answered everyone's question. If anyone has any more questions, fire away. There's only 5 people on the stream right now. It's been going on for 3 hours, so I'm sure people got a little bit tired. Anyway, maybe we'll end it there for Christmas, and then after Christmas we'll come back. And yeah, don't be afraid to ask a couple of questions because it gives me a lot of ideas to share with you guys, like how we allocate capital and more the meat and potatoes as opposed to, yeah, I'm going to buy this and I'm going to buy that. Where are you going to buy it? Well, it looks great. It's not really a very practical way of investing. So there is something to it. And anyway, all right, guys, I'm going to leave it there. I think we're pretty much done. Have a wonderful Christmas, everyone, and we'll get back in the new year. We'll get this capital allocated, and we'll do it again. So have a great Christmas, everyone, and looking forward to a better year next year. All the very best.